earnings season has been pretty stunning.
This might be the peak of earnings.
Maybe 27 earnings are at their peak, and that could be the cause or maybe usher in more volatility for risk assets.
We've seen multiple companies up the CapEx spending that they have and get punished for that.
What is the market looking for? They're looking for that ROI.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday at all-time highs. A four-day winning streak driving the S&P back to another record, shaking off some single-stock trouble brewing at SpaceX and AMD as the White House is once again talking up the prospect of a deal on the Strait of Hormuz.
Let's just be very clear. The reason that we're seeing the first record going back 2 months in the S&P 500 yesterday was not because talks about a deal in the Strait of Hormuz, right? This is not related to necessarily rumors of a rumor of a rumor. This has to do with earnings and the fact that earnings just keep on coming in at incredible highs. It's with respect to Caterpillar yesterday, talking about the forward pipeline being massive, talking about how the build out of AI is absolutely real and coming to fruition. It's likes of Anthropic coming out with a $10 billion infrastructure deal. Palantir's 30% gain in one day. And that is the reason why you're seeing this optimism, even with a couple of pit holes in a couple areas.
Is it fair to say you don't want to talk about the prospect of a deal on the Strait of Hormuz based on that reaction at the top of the program?
No one wants to talk about it. Is it real? Sure. But then you get this question about what's going on in the Red Sea and the Houthis versus Saudi Arabia. Make sense of soup. That's what it feels like.
$80 on Brent this morning, on WTI around 76. Let's talk about tech. Let's talk about a monster rally. Microsoft up 26% in 4 sessions. Huge move. The chip stocks over the same period up by 16%. Big move off the bottom after getting beaten up in the last month or so. Software up every day for the last 8 consecutive sessions. Everything in tech with a few exceptions, but for most of tech right now, there's a massive rally.
Suddenly people are saying valuations look good, and they look good across the board because everyone's had their day of getting beaten up. Yesterday, the Philadelphia Semiconductor Index rose almost 6.5% or more than 6.5%. That is the biggest one-day gain going back to its biggest 4-day advance going back to 2020, as you were saying, the biggest gain going back for one day since March. You look at this and you start saying, is it just sort of a knee-jerk reaction to what we've seen with some of the situational awareness or questions about washout of leverage, or is this something that real and fundamental that can drive the second half?
We'll spend a lot of this morning talking about that. We'll also talk about this as well. I mentioned some single stock trouble. Let's talk about SpaceX. Down in the pre-market, but some comments from SpaceX causing this move for the telecoms. This move right here for Verizon down by 2.6%, for AT&T down by 2%, T-Mobile struggling as well. One quote: I anticipate us being able to acquire quite a few of their customers because I think our service will be better. Starlink Mobile, the focus here.
This is what we were asking about yesterday. Is this ultimately a telecom company? Who are its biggest rivals? Is it the Amazons of the world, or is it T-Mobile and AT&T? Ultimately, this is the real question. What does SpaceX want to be at the end of the day, and where is it going to put the money that it is raising? Does it have the capacity to potentially unmoor some of the traditional standard telecom companies?
How do you value that company seems to be the challenge. Coming up this hour, we'll catch up with Noel Dixon of State Street as equities surge back to record highs. Dan Ives of Yorkville Ives as the SpaceX spending spree gives some investors pause. And Ashok, Bhatia of Neuberger on why markets may be underpricing the pace of disinflation. We begin this hour with stocks at all-time highs as investors shrug off AI jitters. Noel Dixon of State Street seeing more upside potential in tech, writing with room for further increases in exposure. This move could still have near-term momentum leading to more gains. Noel joins us now for more. Noel, good morning. Good to see you.
Good morning.
Why have we all of a sudden set the stage for a massive rally in technology stocks?
So it's interesting. I think if we look at positioning, I think it's largely a function of that. Since the end of June, real money investors actually reduced their tech positioning from about the 98th percentile, if you will, down to like the 80th percentile. Now that we have this optimism, we're starting to see those same investors start to go back into the market. And then when we think about, is there anything flashing red when we look at the risk metrics, absorption ratios, we look at correlation surprise, there's nothing really stark that worries us. So I do think it has legs.
Let's talk about what's going to lead within tech. For much of this year, chips led, software struggled, and the Mag 7 hyperscalers, the big spenders, they lagged. Now everything's starting to rally all together. That
Yep.
feels like initially a bit of a positioning squeeze.
Yep.
From there, where do you see leadership?
Yeah, I still think, hardware, I still think semiconductors will lead. I think, the SOX index still off about 16% based on yesterday's close. I think that can retrace. But I do think there's some opportunity in the software space. I think there was a lot of concern about the hyperscalers, but when we think about how much they're making from a net income perspective relative to how much total debt they've issued, it seems like it's pretty sustainable.
Staying in the chip area, I'm wondering what signal you take from AMD. Yesterday, beating expectations, coming in slightly above, but not above enough to justify an additional rally after a 140% gain. Do you get the sense that this is just a matter of how far some of these stocks have gone and then deciding where to take them from there? In other words, if they haven't performed well, buy them. If they have performed well, sell them?
Yeah, I think it's normal and natural where you get this big move, you're going to get some consolidation. We've come a long way very quickly, but I still think it doesn't change the fundamental story that there's significant demand from a chip perspective, and I think that will continue moving forward.
When does the bond market become a constraining force?
That's a good question. So I think right now the bond market, it'll be a concern if the 10-year gets to 5%. I don't think that's not our base case. I think the only way we get there is if markets interpret Kevin Warsh's move in September. I think that's the risk event, whether that could be, if he holds, if that could be perceived as a policy mistake. I think that is the risk from a yield perspective.
The biggest risk for bonds is that he doesn't hike.
I think it's possible, yeah. So it's funny, the number one question I get from clients is, are they going to hike or not? And I think they're concerned that, the markets are clearly, the front end is clearly saying they want to hike. But the data, June CPI was pretty weak. July is shaping up to be a pretty decent number as well. And just the makeup of the board, I think it's possible they continue to hold, and that could be, I think that could put some jitters in the bond market.
I just want to unpack this a little bit more because it's a change for Wall Street. Lisa asked you, when do bonds begin to constrain equities? And you said once they get to 5%. And then you said something along the lines of, and I'll paraphrase, that if they don't hike, that's a problem for the bond market. Are we now saying that if the Fed doesn't hike, that's bad for equities?
It's possible, yeah, because it's priced in. Again, the market's going to lead the Fed. Right now, the market is saying they want to hike in September. Could that change? I think it's binary. It's all dependent and contingent on how this situation plays out with the Strait of Hormuz. But certainly, if the front end is priced, this is the whole issue with the forward guidance. If the front end is expecting it and he doesn't deliver, that could be problematic.
We are getting forward guidance from the different Fed officials who are speaking throughout the week, and we're getting some hawkish rhetoric coming from the likes of Kansas City Fed President Jeff Schmidt. We heard that from Anna Paulson on the margins yesterday. How do you prepare differently to get economic data in an era where each data point could be determinative with respect to what the Fed does?
So it's very difficult. I think right now, you have to rely not just on your high frequency conventional data, but you also have to look at alternative data and try to get a sense of where things are ultimately going to head. Because to your point, every data point can shift the market. So it's just a new regime of volatility that I think we're just going to have to get accustomed to.
What's the best hedge right now against risk assets, given the concern of inflation and given the concern about potentially a Fed reaction function that does not constrain the long end?
Yeah, so I think a good hedge is to probably look to buy gold. I think, obviously you could look at, volatility is pretty cheap. So we love looking at, 1 month vol spreads, things like that. I think those are good opportunities given how cheap vol is today.
Gold up this morning, buying close to 2%, 41.52. It's good to see you, Noel.
Good to see you.
Buying. Noel Dixon there of State Street. It's a change on Wall Street. Look, I don't have a view, but I'm going to say, just from an observation standpoint, that is a massive change to me. To hear someone say that you could avoid a hike, but that is bad for equities, is something difficult to get your head around.
Essentially, the market is going to do the work for the Fed if there isn't a hike at the Fed. And right now, what I find interesting is that the debate between whether or not the Fed needs to hike seems to have been completely overshadowed by this question of who Kevin Warsh is. So suddenly, the main zeitgeist is that a hike is necessary. You're even seeing a sort of hawkish tilt among Fed officials who might not have otherwise had a hawkish tilt. I'm just throwing that out there, given some of the potential disinflation that people were talking about earlier. It seems like the market is voting that we need a rate hike to constrain the long end of the yield curve. And if the Fed isn't willing to do it, well, then it's off to the races for the vigilantes.
Wouldn't it have been super bullish back in the day for me to sit here and say data's OK, pretty resilient, manufacturing's bouncing back, got lots of spending in the economy from some of the biggest companies on the planet. You're seeing earnings take off in a material way, 20% plus on the S&P 500, and the Fed's not going to hike. The Fed's not going to hike, inflation's above target. Wouldn't that be an argument to buy equities, not sell equities? But I get it. The concern has shifted out along the yield curve, away from the front end, and overwhelmingly the focus is on what happens to 10s and to 30s.
People are worried about another Arthur Burns tenure at the Federal Reserve, and the 1970s were not a good time for risk assets.
We'll be talking about that a little bit later this hour. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. AMD giving an underwhelming sales outlook, saying its third quarter revenue will come in around $13 billion. That missed some of the most bullish estimates. CEO Lisa Su telling analysts the company expects data center revenue to more than double next year, and that growth could top 100%. SpaceX shares falling in the pre-market after its first earnings since going public. Capital spending soaring as Elon Musk pushes ahead with his AI and space ambitions. The company posting a smaller than expected loss and revenue beating estimates. AI models by OpenAI and Anthropic revealing more unsanctioned actions during security tests. The UK government's AI Security Institute saying both engaged in sustained, potentially harmful activity directed at real people and organisations during evaluations. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you for the update. Up next on the programme, moving towards a deal.
I think it'd be very smart to make a deal. They had a very good day. The negotiations were good. We're moving along very nicely. We'll find out. We'll know in 48 hours.
Up next, Lisa's going to take a little break, and we'll catch up with General Carol Gibson of Academy Securities. You're going to stick around? 5 minutes off.
I mean, look, it's important story. It's just I think everyone's sort of like, all right, what are we going to learn?
Live from New York City this morning. Good morning. Record highs on the S&P for the first time since early June, adding some weight to the rally, up a third of 1% so far this morning. What a rally we've seen on some massive single names. We talked about Microsoft, 4 days, 26%, the biggest 4-day move we've seen since the year 2000. For chip stocks, a massive move there as well, up 16% for semis over the previous 4 sessions. And for the software names too, 8-day winning rally, up 17%. Just a week ago, we were talking about the bar being too high for earnings, or the good news is priced in, and now we're talking about position squeezes a week later.
Yeah, I'm not sure where the narrative is. Essentially, it's if the stock has been beaten up enough and the earnings have increased enough to present an attractive kind of valuation prospect, then all of a sudden people say it's cheap and let's go into it, regardless of some of the other existential fears that were apparent before. The issue is for names that still have gotten really big gains, and I think AMD is a good example of that, up 140%, and even better than expected earnings, at least in the headline level, were not enough to keep that momentum going.
You could feel the turn in sentiment into the weekend. We noted it. Situational awareness blows up. You have Max Kettner of HSBC write about it, that would be used almost as a convenient narrative to explain away the weakness we saw in July, and maybe an opening for everyone to start buying again. And in some ways, that's exactly what happened.
Yeah, essentially people got the confidence that maybe the whale in the market that had been causing a lot of volatility had been pushed out. I would argue that some of the gains that we're seeing doesn't exactly make you feel like the volatility is gone. They're just volatile in the right direction for a lot of long investors. That said, I wonder who this is coming at the expense of, and whether it's coming in part at the expense of some of the frontier models that are suddenly losing pricing power in an era of open model dominance coming from China. And I do wonder if the economics are getting better and investors can see that because of some of this competitive pressure.
Nasdaq futures this morning down almost 1/10%. Under surveillance this morning, let's talk about oil moving towards a deal.
A lot of progress has been made. And they called me and they said, please, let's talk. I think it'd be very smart to make a deal. They had a very good day. The negotiations were good. The stock market was up tremendously over the last 3-4 days. We're moving along very nicely. We'll find out. We'll know in 48 hours.
So here's the latest this morning. The president saying a deal on the Strait of Hormuz could come as early as today. Axios reporting the US, Iran and Oman are gearing up to announce a 60-day agreement to reopen the crucial waterway. Bloomberg's Abu Amar joins us now from Dubai for more. Abir, welcome to the programme. We have been here before, several times. What's different about this moment?
Well, it looks like over the past 90 minutes, we are not seeing much difference because, John, Iran did come out through state media and said, actually, the negotiations that are happening don't have the U.S. included in them, that the negotiations when it comes to the Strait of Hormuz are happening only between Iran and Oman at this point. Here is a line from that Iranian state media citing a source familiar with the matter, saying that the potential agreement between Iran and Oman regarding the passage of vessels through the Strait of Hormuz has nothing to do with the United States. It is merely a mechanism that is being discussed with Oman for the time being. Now, we've reported this over the past week, John, saying that Iran and Oman are discussing some kind of mechanism to help ships or the trickle of movement through the Strait of Hormuz. Axios, in the early hours of our morning, reporting that this will be a 60-day agreement that will establish an immediate opening of the Strait of Hormuz. Iran saying that is also not true. It is not going to be opened immediately. So we're seeing the back and forth yet again. President Trump this morning saying that we'll see over the next 48 hours. He was touting that a deal with Iran could be imminent. We heard similar notions from Marco Rubio, from Scott Bessent. But one thing is for sure here, and that is any deal that is currently being discussed is really just about the flow of energy through the Strait of Hormuz, the Strait of Hormuz per se, and nothing about that nuclear component, nothing about the 14 concessions, John, that were spoken about in Switzerland in June. We are again at wait-and-see mode to see if that deal is, in fact, imminent on Wednesday, as President Trump and other U.S. officials have been saying throughout the course of the day.
Watch this space a bit. Appreciate your time. Fantastic coverage over the past few days. Bloomberg's Abu Amar out of Dubai. General Karen Gibson of Academy Securities writing, there's no evidence today that America's punishing airstrikes have affected Iran's strategic calculus or diminished Iranian resolve to control the Strait. General Gibson joins us now for more. General, welcome back to the programme. We've been here before. We've talked about this kind of deal before as well. And then Iran has continued to attack ships through the Strait. Do you believe this is different this time?
Well, I do think this is different in that these appear to be largely constructive talks. That's based in part on what we're hearing from Qatari interlocutors. Constructive talks between Oman and Iran on the kind of mechanism that might allow the transit of vessels through. As I understand, there will probably be a service fee as opposed to a toll, still a cost, but a service fee, perhaps a more palatable term for fees that are paid, as well as some kind of mechanism that they jointly administer that would allow vessels to go through. As we just heard, even if this is approved, it's not going to suddenly free navigation through the straits. There's demining that will need to happen. And even when we hear things positively on the diplomatic front, I think we also need to wait and see what happens in terms of the IRGC and how they respond. And then a third element that I would introduce is potentially a demand that the U.S. lift its blockade of Iranian ports before Iran allows this new deal to be implemented.
General, what are the odds of ever going back to the pre-war status quo? Do you think that we have changed that region potentially forever?
Well, I do. Yes, I think it's... While we will see at some point, I think, a return to free navigation, it won't be exactly the same. For one, we have not addressed the underlying geopolitical risks that got us here in the first place. And the U.S. is no closer to achieving the nuclear goals that it set out to achieve when it began this campaign. And then third, I think I would say that Iran has demonstrated its willingness and ability to choke off the Strait of Hormuz and is cementing that as a form of control. It will not be exactly the same going forward.
General, how do you understand the strikes by the Houthis on Saudi Arabian tankers in the Red Sea in particular over the last couple of days? Why are they getting involved now?
Yeah, so that's a great point, and I'm glad you brought it up because even this deal between Oman and Iran does not address the issue that the Houthis have over in the Bab el-Mandeb. So the issue between the Houthis and the Saudis, two bordering nations, their disputes go back far longer than the Houthi alignment with Iran. It is personal between the Houthis and the Iranians, and I often remind folks that while the Houthis are an Iranian proxy, they are not a puppet. And of all the proxies, they tend to operate the most independently and are much harder for Iran to control. They're happy to take Iranian financing, Iranian weapons, advanced technologies, but not always instructions. And so even as this deal is struck between the Iranians and the Omanis, or a mechanism for coordinating navigation through the Strait, the Bab el-Mandeb remains, at this point, an unresolved issue.
As a longtime member of the U.S. military, I would love your reaction to some of the reporting that we got out yesterday about munitions in the United States and how low stockpiles have gotten in light of this ongoing conflict and broadening conflict across a host of different theaters.
Yeah, so anytime that you're expending munitions faster than the industrial base can supply them, and that always happens in a conflict, you will draw down your stocks. I think in this case, as long as this has gone on far longer than originally planned, certainly we have drawn down those weapons and our inventory much less than the department is comfortable with. And I would point out that these are munitions that are used by allies like Ukraine. These are used by certainly our Middle Eastern allies. They are also used in Northeast Asia to prepare for potential contingencies that would involve North Korea. So it is really a more global problem. And I would tie this also to the acts of Iran of the last 2 weeks, where they demonstrated an ability not just to close off the Strait of Hormuz, but to affect shipping or ports and infrastructure in the Red Sea and as far as Egypt, demonstrating that they can hold anything at risk. Those Gulf allies, they rely on these munitions. I'm sure that was part of their calculus in compelling the president to hold off on yet again another threatened intense airstrike.
I think that point is quite critical. General, do you believe we are at the point where that issue around stockpiles of ammunition is beginning to influence, perhaps even dictate, the U.S. approach to this situation?
I think influence is fair. Dictate, perhaps not, but certainly is a factor that should be taken into consideration as you consider our endurance. That is probably one of the most critical shortcomings that we would have right now.
General, appreciate your time. Thank you. General Karen Gibson there of Academy Securities. Dictate probably too strong. Influence, I think that's where the consensus is right now, and that's concerning.
Well, when we talk to a lot of people who are close to the military, they talk about how this has been a factor, and it's increasingly a factor because the nature of war has changed. You can execute many more strikes much more rapidly. To the point that the general was making about the global resources, there was a report that a number of people in Ukraine were killed overnight in a Russian offensive that would have otherwise been able to have been deflected if they had had some of the defensive munitions that they previously had. And what we heard from the country was that this was a direct consequence of there not being enough munitions out there to help support their cause. This goes far beyond just an issue of the Middle East. This has to go to the global stockpile and how that realigns some of the global powers.
This plays into the uncomfortable new normal we've been talking about, just toggling between strikes and talks, with no real runway for a sustainable diplomatic solution. Brent crude 2 Fridays ago was triple digits. This morning is at 80. A month ago it was in the low 70s. We've been all over the place. Tons of volatility for crude in the last 30 days.
What you've actually seen is inflation expectations come down to some of the lowest places that they've been going back to 2024, at least at the front end of the yield curve. People seem to be shrugging off the idea of some sort of massive obstruction of flows for a long period of time. Even with this ongoing conflict, it seems like the status quo will involve some sort of transportation of oil bearers through the strait.
That move in crude helped yields retreat just a bit, which alleviated some of the concerns in equities as well on the margin. The move in oil, the move in equities, just a bit, Bramo.
Yeah,
just a bit.
You're not wrong. It sets the mood music. It's just an exhausting mood music.
Dan Ives of Yorkville joins us next to talk about SpaceX. SpaceX down in the pre-market by 11%. What a rally in 4 days. Record highs on the S&P, record highs on the equal weight. The biggest one-day gain we've seen in several months on the S&P 500. 4-day rally up by close to 6 percentage points over that period. Futures up again by a third on the S&P. On the Nasdaq, just about unchanged. Some single stock trouble out there. We'll talk about it all morning. AMD and SpaceX being two of those names. But within that, away from that, the tech story's just been on fire over the past few sessions.
This is coming from Vishal Vivek of Citigroup, saying that his conversations with a number of different clients suggest they're bullish on the fundamentals across these tech names. They've been looking for an attractive entry point, and the washout following strategic ambiguity, that's what I'm going to call it, situational awareness, strategic ambiguity.
Okay. You're just coming up with that on the spot. Was that intentional? I don't know. I like it. I don't think so. That should be the second. That should be the second fund.
Situational awareness, strategic ambiguity. That was a good washout, and it created a good entry point for them.
Nice work, Bramo.
Thank you.
It's some of your best works on the fly. Jonathan Krinsky of BTIG, by the way, was pretty punchy in his note yesterday. I'll share some of that with you. The S&P 500 has surged 5% over the last 4 trading days into a 52-week high. In the last 30 years, his stat, this has only happened 3 other times, including March 21 in the year 2000, which was the dead highs of the dot-com bubble. The latest from Krinsky over at BTIG.
Well, he's been calling for some sort of parabolic move down, and we had seen part of it, but it wasn't necessarily the washout that he thought was necessary because of some of the parabolic moves that we've seen upward. That said, he seems to be in the minority because other people are saying earnings have caught up to where valuations are and then surpassed them dramatically, as a lot of these names haven't done anything, and as a result, people are finding an attractive entry point. That said, do they have the wrong paradigm for valuation? You can ask all of these other questions as well.
Let's turn to the bond market. Yields retreating helped the rally in yesterday's session as well across 2s, 10s and 30s. A number of reasons for that. Crude is one. The other's the data. Job openings a bit softer than expected, heading into a week full of economic data. ADP coming up a little bit later this morning.
I don't know what conclusion to draw from JOLTS because the headline number was a little bit below what people had been expecting, but the quits rate was a little bit above what people had been expecting.
Hiring was okay?
Hiring was fine. The layoff number wasn't that significant when it comes to past history. So the internals of this lead you to believe that this is a job market that still is doing just fine, which is why you see a lot of the Fed officials skewing to the more hawkish.
Should we turn to crude? I know you're desperate to talk about it.
I've been eager all day.
WTI and Brent looks like this so far this morning. I'll try and frame this for you. So, Qatar say a proposal has been drafted. We know that much. The US and Iran apparently reportedly open to a deal. Secretary Rubio's come out on the record and said progress has been made on a deal on the Strait of Hormuz exclusively. Beyond that, what have we woken up to this morning? The Houthis threatening shipping again through the Red Sea, the push and pull, the effort to try and establish leverage through this negotiating period, if it is 60 days, will continue, and it will continue to be volatile.
Yeah, and this is the reason why a lot of people are just saying, okay, we have to pay attention. It does set the mood music. We need to understand whether there's a bigger catalyst that's evolving here, but otherwise, it's not going to materially shift people's views beyond that. I would say that if you were going to have strategic ambiguity as your fund, you would have a heavy position in oil, because right now, it seems like there is a lot of unclarity. The real only certainty is whether there actually are barrels going through the strait. And right now, people are saying and evaluating that there is still a trickle going through.
Numbers from Disney just dropping. We'll turn to that in just a moment. Give us a few moments to digest that data. Before we get to that, let's get you some morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. SpaceX getting a harsh welcome as a public company. Shares are falling 11.5% in the pre-market after the company unveiled much bigger CapEx numbers than Wall Street had expected. The quarter itself was good, but you can just feel the angst as investors digest the enormous amount of capital that will be needed to turn this from a rocket company into an AI infrastructure one. Plus, the company's IPO lockup expires today, allowing insiders to sell shares for the first time. So that is also adding pressure to the stock. And due to comments on the SpaceX call from President Glenn Shotwell, we are seeing the wireless providers AT&T, T-Mobile, Verizon falling in the pre-market after she laid out the company's clearest vision yet for taking on this industry, saying it plans to build out the terrestrial infrastructure needed to turn Starlink into a true mobile service. And reading through analyst notes on this, they are mixed. Some saying that it will take billions of dollars of investment and years to just be on the same playing field as these guys, while others say don't underestimate SpaceX's ability to innovate and take on these well-established players. And we end on AMD also falling victim to high expectations. The stock has more than doubled this year, leaving little room for disappointment. So while it did beat on earnings and revenue, the guidance failed to clear Wall Street's highest expectations. So we are seeing pressure on the stock as well, down nearly 9%. John.
Yahara, thank you. Thanks for the update. More from Yahara in the next hour. Let's get to the Walt Disney Company, up in the pre-market nicely by, let's call it 2%. Numbers dropped just moments ago. EPS, adjusted EPS for the third quarter coming in at $2.06. The estimate, $1.86. That's a nice beat. The first thing I was looking for was the experiences business. It includes parks and cruises. Profit there rising 20% to a little north of $3 billion. They are crushing it over at Disney.
This is the story we're hearing from airlines. This is the story that we're hearing from all of the hotel companies, that ultimately people are still into experiences and traveling. And you see that in the numbers. I mean, across the board, it seems like they beat valuations. A real question here also about some of the other macro backdrops. I love Disney because it really touches both the experiences, also tariff refunds. They said that they recorded about $100 billion in tariff refunds over the quarter. And then, of course, the sports and entertainment aspect of things. The fact that they had such a big beat on their sports revenue, coming in at 4.5%, about the same as what was expected, 4.5%, speaks to kind of the World Cup and some of the excitement around trying to acquire sports-related rights, even if they're really expensive.
Let's just get back to basics. Airlines, cruises, parks. Right, you've seen it throughout earnings season, to your point. Great. Look at MasterCard, the numbers coming out of the credit card companies. Fantastic, pretty decent. People are still spending. You can see that in the economy. You see it in these big names.
And you see a certain degree of pricing power when you have these names, because ultimately they've been able to raise prices in tandem or surpassing even the costs that they are experiencing and incurring as a result of operation. To me, this just ultimately goes to the point that the economy is in a strong place. And this is coming from more than just artificial intelligence. Maybe these people are all feeling the wealth effect of their AI-related stocks. Nonetheless, people say that's probably not the case. And one of the hallmarks of this earnings season has been the broadening out of the earnings that we've seen, and frankly, the way that we've been seeing that in the data as well.
It's a nice story, cashing in chip stock profits in July and taking some vacations.
I think
right? Is that what you're suggesting?
Are you putting words in my mouth?
No,
Sure, I would love to, but I will say this. I don't think you're going to be going on a Disney cruise.
No, I won't be. But don't use me as a barometer for this stock, right? Otherwise, you'd never buy Disney or the cruise stocks or anything.
I would agree with that. I also think that nobody's really taken enough time off. And I would argue every single person who comes into this show, we ask, oh, how was your summer? And they say, what summer?
Not as quiet as I thought it would be.
Yeah, I thought it was going to be able to take time.
I don't remember the last time we had a quiet summer. Give me a break.
OK, but this has been an especially volatile one.
It's been very busy. Oh, yeah, it started with Maduro. Do you remember that?
No.
Lifetime ago. Disney right now in the pre-market up by 3%. On our radar this morning, President Donald Trump saying a deal to reopen the Strait of Hormuz could come as soon as today. The US, Iran and Oman reportedly preparing to announce a 60-day agreement on shipping through the waterway. Elsewhere, AMD shares pulling back. The chipmaker's sales outlook falling short of the top end of Wall Street expectations. Shareholders hoping for higher returns from the AI build-out. The CEO, Lisa Su, expecting data center revenue to more than double next year. And finally, SpaceX also taking a hit. The company reporting higher than expected AI spending, overshadowing an otherwise robust first earnings report. Elon Musk telling analysts the company's year-end run rate should hit $100 billion, nearly 3 times above estimates.
You know, my big question coming out of this earnings is Elon Musk losing his clout as the promiser of dreams and hopes? Because ultimately the performance was great. It was just a matter of the spending coming in so much bigger than what he had previously expected, and where he's spending, which is on becoming a hyperscaler or some sort of hyperscaler competitor, not the areas where he's actually bringing in revenues, which is in the telecom business and in the space business.
There's a massive test for this stock coming up, and it has nothing to do with the underlying business. It's the beginning of the end of the lockup. and it's going to be a staggered end to that lockup as well. And there's just a view they need to wait and see how that plays out over the next 6 months or so, and how much Bryan will step in to mop it up.
Yeah, $100 million, I believe, are going to be coming up for sale in the next couple of days. And then after that, you'll have to see who is going to want to buy into a name that is leveraging its future on a less certain business at a time where there are plenty of competitors.
SpaceX down in the pre-market by 12%. Dan Ives of Yorkville Ives writing the following: the CapEx tug of war between SpaceX and investors is a necessary build-out that will require patience. Dan joins us now for more. Dan, whose patience and how much pain will we see for the stock in between?
Look, I mean, this is a barometer for what we're seeing across tech, because the reality is this is an arms race. And when you think about what SpaceX is doing, the only way to get there is CapEx. And I think that's the double-edged sword as going public, because the scrutiny is going to be there. But look, we've seen it across big tech, you know, when it comes to the hyperscalers on a different version. That's essentially what's happening with SpaceX as they're trying to catch up to OpenAI, Anthropic, and as Lisa talked about, really building out the vision.
Do you think that this is the right move, Dan, to really lean into the hyperscaler side of things, the compute side of things, when really the money is coming from the space and the telecom sides of things?
Yeah, I think that's the quagmire that they're going through. And look, it's no different than so many other companies that we've seen. I mean, you go back to NVIDIA, right, where it's gaming and then going after AI. The reality is that the gold at the end of the rainbow is around data, AI. It's going after that opportunity. And I think that's what they're doing. It speaks to XAI and ultimately what probably could be Tesla as well. That's the broader vision of Musk. But the only way to get there is CapEx. And I think when you're going through this arms race, where, and you see it from all the chip players, all the memory players, costs are getting more expensive. And you're not just one of one in a room, you're one of many trying to get after those chips in the build out.
Dan, if you were trying to figure out where you were going to lend your pool of cash, why would you choose SpaceX for some of those data, AI, LLM types of promises and dreams, rather than either Anthropic and OpenAI on one side or Microsoft and Amazon on the other?
Oh, no doubt. I mean, they definitely are at the low end of the totem pole relative to those players. And I think that for them is the challenge. The hyperscalers, if you just think about this earnings season, I mean, they come out flexing muscles relative to what we're seeing. And when you look at OpenAI and Anthropic, I mean, it's really their world. Everyone else is paying rent. Everyone's trying to play catch up, and that's the challenge. Now, for Musk, he's been there many times before, but that's really the opportunity. If anyone's buying into SpaceX, you're buying Musk, you're buying the vision, and you're playing catch up.
The price of capital, Dan, for these guys is going up. It's higher. In the next hour, we're going to have a conversation around this table about how rate insensitive these spending plans are. But I do believe everything's got a price, and at some point, Dan, there is a price at which these companies are no longer willing to pay. Are we close to that, Dan, where markets and the pushback, whether it's equity or whether it's debt, begins to dictate or even influence the spending plans of these companies?
Look, I think right now, I think Oracle will be a great example, relative to the OpenAI deal and just taking on debt and what's happened to that stock. Look, I think for these companies, it's a balancing act, because they know if they lighten up on CapEx, they go to the back of the line. And it goes back to this is the building of the Vegas Strip, 1955.
Well, Dan, I think that's the issue, though. Just allow me to jump in. Why do you want to buy them as they go through that difficult phase? Why do you want to be buying them now?
I think if you look at Microsoft and you look at Alphabet, those are two good examples where as they're going through it, you're basically in the build-out phase. Investors now, the switch has gone on. You've actually seen the monetization. I think the question, John, is that when do you start to see the monetization switch? And investors are basically betting near-term pain for long-term gain. But there is a push-pull point. And I think as we get into the debt market, these companies take on more debt and more equity. I think Meta is a great example. You have to show it. You can't just talk it. Alphabet, Microsoft, you look at Amazon, I think you got to prove it, because it can't be the dog ate the homework every quarter.
Dan, it's good to see you. As always, Dan Ives there of Yorkville Ives, still constructive on these names. SpaceX getting slammed in the pre-market.
Because people can't see exactly the path for their preeminence in this particular field of data collection, AI-related large language models. And ultimately, they do have a great business that they could lean into, but where they're putting the CapEx is in trying to compete with others who also still have a great business.
And Meta does too.
Right.
It's another example of having a very profitable underlying business in there somewhere.
Clarity of vision. The companies that have clarity of vision are getting rewarded for it. Those that have a muddied vision or a vision that's overly broad without a clear sense of how you get there, not so much.
It's been a theme for us over the last week at both the likes of Meta and the likes of the Federal Reserve. SpaceX down this morning by 12% of the pre-market. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Record low water levels are disrupting trade and tourist cruises on the Danube. Nuclear plants in Romania and in Hungary are under threat of being shut because there's not enough water to cool them. Disney shares up by 4% in the pre-market. The company's third quarter results beating on the top and bottom lines. Soaring income from its entertainment division and the resilience of its theme parks in California and Florida driving profits. Citadel's flagship fund surging nearly 6% in July after the firm bought that portfolio of AI stocks from troubled hedge fund Situational Awareness. Sources telling us here at Bloomberg the transaction helped boost Citadel's year-to-date gains to 12%. And that is your Bloomberg brief. John.
That's one way to get it done. Vonnie, thank you. Appreciate the update. Up next on the programme, the inflation debate.
Underlying inflation has remained well above the Fed's target.
There may be good reasons to expect inflation to cool down, but the question is whether it cools down in such a way that it satisfies the word soon.
We do think inflation will be behaving more in the second half of the year.
That's the hope. We'll get the outlook from Ashok Bhatia of Neuberger in just a moment. From New York City, you're watching Bloomberg TV. Coming up a little bit later on this morning, more economic data, ADP at 8:15 Eastern Time, and then another read on services in America, ISM. Look out for the ISM at 10 a.m. Eastern Time. More data throughout this morning, building up to the big one on Friday, the payrolls report, the estimate in our survey, the median estimate is still 80K. Equities this morning doing okay on the S&P and on the Nasdaq. On the S&P 500, adding some weight to the rally, up 1/3%. In the bond market, 2s, 10s and 30s. Yields yesterday retreating somewhat. 2s still around 420, 10s around 460. Under surveillance this morning, it's the inflation debate.
Underlying inflation has remained well above the Fed's target.
Inflation's too sticky for too long.
There's not a lot to suggest that you have a lot of disinflationary pressures.
There may be good reasons to expect inflation to cool down, but the question is whether it cools down in such a way that it satisfies the word soon.
We do think inflation will be behaving more in the second half of the year.
So here's the latest this morning. The Kansas City Fed President Jeff Schmidt calling for tighter policy to rein in inflation. Ashok Bhatia of Neuberger taking a non-consensus view, writing, "We believe inflation is on track to move back towards central bank targets sooner than the market expects. By year-end, we expect the Fed to be within close reach of its inflation target." Ashok joins us now for more. Good morning, sir. It's good to see you.
Good morning.
Give us the constructive view. What's the path for disinflation?
Well, let's just start. Core inflation year over year is running about 2.6%. And our view is that over the course of the second half of this year, and particularly in the fourth quarter, we're going to start getting monthly prints of 0.1 to 0.2%. And that is sort of the core reason that, 6 months from now or so, we're going to start looking at a core inflation number that is at 2% plus or minus. So it's effectively the Fed is going to, we think, get bailed out by lower inflation data. And what's driving it? It's really a combination of shelter is coming down. We see weaker goods prices and goods disinflation or lower inflation in the goods market. And then services. I think one of the things that the bond market and maybe the whole markets are missing is wage gains continue to decline. We're at 3.5, 3.6%, year over year wage gains. And that's leading to some pressure in services inflation. So you don't need a big tick down in these monthly inflation prints. We got a 0.0 print last month. And that's enough to get the Fed within spitting distance of its target and keeps the Fed on hold.
The labour market hasn't been a tremendous source of inflation for much of this year. That much is true. Some people might point to the massive spending we're seeing, the AI spend, that is going to keep prices elevated. What's the counterpoint to that?
The counterpoint is that there you are seeing the elevated prices in chips and some of these inputs, but look at what the U.S. consumer spends its basket on. About a third of it is on housing, about 10%, 12% or so of it is on goods. But, you know, we talk about chips, but we don't talk about cars and used auto prices and some of these other things that are more meaningful for the consumer basket. And we're certainly not saying that this is like smooth sailing and that this is all one way. But there are enough pockets of disinflation that get the Fed back down to its target. And I do think one of the most remarkable things about the bond market is if you look at the inflation break-even market, inflation break-evens 5-year and 10-year, they're lower on the year. I think that surprises most people, but 5-year inflation break-evens are at 220. That's down a few basis points for the year. When we think about all of the inflation discussion we have and all of the noise around it, the bond market is signaling a much different message about the inflation path, and I think it's much more in line with our view for how things develop.
Yeah, one-year inflation expectations fell, I believe, to the lowest since 2024 in the past week. How do you understand, then, the sell-off in the long end of the yield curve in the wake of what was perceived as potentially a dovish or just absent message from the Federal Reserve last week?
Yeah, I think this year is all about real yields. So if we look, the front end of the bond market, the 2-year point is up about 70 basis points. The long end is up about 40 basis points. That is almost 100% real yields moving. And I think it's just two stories. It is we are moving into a world where, you know, a few years ago we were talking about excess savings and savings gluts, nothing to invest. Suddenly there's a demand for capital, you know, as you were talking about with the AI spending, and it's government spending. Governments are spending a lot of money, and the private sector is now spending a lot of money, and bondholders are demanding, you know, a higher real yield. And, you know, real yields now have moved up to about 2.5%, which is certainly the most elevated levels, you know, we've seen since the financial crisis.
We've been asking everyone, we've been trying to be bond salespeople and say, you know, do you want to buy the 30-year? Do you want to get that extra yield, or is it not enough to entice your capital away from the promise of hyperscalers and AI preeminence and more yields in other places?
Well, I don't think you want to go buy the 30-year Treasury. I think the better place to be on the Treasury curve is 10 years. The one thing I do think that's interesting now on the 30-year point is the hyperscalers. We have seen this significant widening. And actually, hyperscaler debt, we think, is now looking relatively attractive and cheap to what's going on in the securitized market and the high-yield space and the general IG market. So I think it's buy 10-year Treasuries, 5-year Treasuries, and then you can add a little 30-year hyperscaler at this point.
OK, I've got to ask. Even for a man who sees a path of disinflation back towards target and a Fed that doesn't have to do much, you still don't like the 30-year Treasury, but you do like the long-dated hyperscaler credit. Why do you dislike the US 30-year so much?
Well, I think it's the government debt issues. We are going to be in this, I think, persistently environment until the fiscal situation changes, that the government is going to be demanding more capital. And you get into an environment where, you know, the Fed stays on hold, which is sort of our core view. We can continue to see the 30-year just sort of stay around these levels while some of these shorter and intermediate rates, you know, fall as you end up seeing the Fed, you know, we take out the Fed hikes. The 30-year hyperscaler is really a message that spreads are giving you a lot of compensation for the credit risk at this point. And so even in an environment where 30-year Treasuries stay around these levels or move up, you've got enough protection and spreads with where they are that's a better use of 30-year investment capital.
I think we're going to reflect on this conversation throughout the week from here. It's good to see you.
No, it's good to see you
Thanks
guys.
for being here in New York. Ashok Bhatia there of Neuberger, Berman. That's quite a line, isn't it? That's quite a line, that I'd prefer to buy 30-year hyperscaler credit than I would the 30-year Treasury. Essentially,
because he's waiting for Washington to blink. And so are a lot of other bond investors. They're waiting for policymakers to understand that the bond market is speaking to them and they have to listen. And do they have to exert more pain or see more pain in the bond market before there is some fiscal discipline down in Washington?
And yes, right. 520 doesn't get it done.
Well, that's essentially what we're seeing. And people are saying, well, it seems like the bond market's saying, let's see how high we can get this.
It's not 520. Yields this morning, 516.80 on 30s. Up next, Alicia Levine of BNY Wealth, Ariana Salvatore of Morgan Stanley, Bryan Whalen at TCW, Collin Martin of Schwab. From New York City, the second hour of Bloomberg Surveillance. Up next.
Fed's walking a very fine line here. And
part of this narrative here is definitely inflation expectations.
We're not crying because we need the forward guidance. We are looking for a plan, and we don't see one right now.
We are so grateful to those Fed speakers who are willing to explain their reaction function.
We are clearly dancing in the dark now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. And your scores, the price action looks like this. 4-day rally on the S&P 500, higher by more than 5% over that period. This morning, advancing 0.4%. We've talked lots about the single name trouble throughout this morning. AMD, SpaceX down in the pre-market, but the focus firmly elsewhere, beyond the 12% decline on SpaceX. It's the rally that you've seen on the likes of Microsoft, 26% advance in just 4 sessions.
And you pointed out it's not just the hyperscalers, it's also the semiconductors, it's also the software names. The Philadelphia Semiconductor Index is up the most over the past 4 days going back to 2020, akin to what we're seeing in Microsoft. And going back to this Citigroup report where they said essentially a lot of investors have been bullish on the case of all of these tech companies and have been waiting for an attractive entry point. And situational awareness or strategic ambiguity, whatever you want to call it, was perhaps the entry point for so many different people to come in and say, this is my time to buy.
Whatever you want to call it.
Well, I think that it switched from situational awareness to strategic ambiguity.
Clearly a strategy for Ken Griffin over at Citadel, given the gains we've just seen and the profit they made in the previous month.
They were up 0.5% before they bought this portfolio for a month, and then they were up 6% after that. So congratulations, Ken Griffin.
It's a nice power to have.
Exactly.
Right? Not everyone has it, unfortunately. Let's turn to the bond board. Check it out, 2s, 10s and 30s. Fantastic conversation with Neuberger just moments ago. Look at the 30-year piece of the Treasury curve this morning. We're down by a basis point, 516.38. You've got tons of issuance coming into this market on the credit side. Lots of supply from the hyperscalers. What do you want to buy? What does he want to buy? He would prefer to buy a 30-year hyperscaler credit piece than buy the 30-year Treasury this morning. What does that tell you about the debt market?
This tells you, and Ashok Bhatia put this perfectly, where he said, right now, they know that Washington, D.C. has to sell a lot more T-bills, has to sell a lot more Treasury notes, has to sell a lot more debt. And frankly, they're exacting a price for it in the bond market, especially because there is competition. We have seen a sell-off in hyperscaler debt over the past couple of weeks. You have seen a widening in those spreads. And as much as people see opportunities in the equity side of things, they're seeing opportunities in the debt side of things, especially as compared to potentially a blank slate when it comes to what Washington, D.C. is prepared to do with its fiscal overhang.
The price of inaction. Eric Cantor sitting around this table just yesterday on the price of inaction. The price of inaction needs to be greater than not acting at all. And for that, you need to see the yield go higher. Is it 525? Clearly not. Is it 530? I don't know. 550? 6%? When do high yields beget high yields and they finally wake up in Washington? We've been talking about this for decades, but now there's a new entrant in the debt market. It's the biggest companies on the planet. Now they go negative free cash flow, they have to issue debt. You've got competition for capital and yields have got to go up. Yields have got to go up to get Washington's attention to do something about it. Are they going to do something about it?
Well, yeah, what's the price to get the attention of Washington, D.C.? You know, can you make a TikTok video yet about the deficit? Well, no. And right now, when I talk about the deficit, people turn it off. So that's the reason why I assume that we have to get a little bit to higher yields to get to that conversation.
You can tinker around, bring in issuance, make it really short term. We've seen a lot of that. But have we exhausted that effort?
There was some speculation that the moves in Japan were ahead of the refunding announcement. We're going to get that later today. In terms of exactly how this Treasury Department plans to refinance itself, expect a lot on the short end, but you can't fund yourself forever on the front end, and that messes with some of the functioning of the Fed as well.
You can try. The Fed stays on hold, doesn't move. Guess what gets punished? Dollar gets obliterated in that scenario.
Well, and we've
gets
already
hammered.
seen. Yeah, well, look, there are a lot of questions about exactly what the strategy is, and that's the reason why the void has been filled by other Fed officials who seem squarely focused on the front end of the yield curve and ready to act. So we'll see exactly how this shakes out.
Coming up this hour, we'll catch up with Alicia Levine of BNY Wealth as earnings continue to drive markets to new record highs. Whalen of TCW joins us on Wall Street's massive push to unload billions in AI data center debt. Plus, Collin at Charles Schwab seeing an increasing chance of a rate hike later this year. We begin this hour with stocks adding to the record-breaking rally. Alicia Levine of BNY Wealth recently raising her year-end target for the S&P to 8K. Earnings took over from macro in driving markets. The CapEx cycle continues to support the economy and industrial sectors as hyperscaler spending is powering earnings of 20% of the S&P. Alicia joins us now for more. Alicia, good morning.
Good morning.
What a massive run we've seen in just a few days on tech. It's phenomenal. What are you telling clients?
It's phenomenal. Look, we think the market ends higher at the end of the year. We're in print at 8,000. I think it's probably moving higher. The forward earnings growth rate right here of the S&P is actually 30%. So the multiples come down even now. It's, the market sort of tread water around that 7,500 range since mid-May. Kind of stuck there as the market rotated, and as you talked about, we've had these clearing events. There are major questions hanging over this market. The first of which is the war restarted, oil prices are higher, yields are higher. Can the market rally if the 10-year is over 4.5%, which was really the bogey in this entire cycle? The answer is yes, it can. The second thing was, is there ROI on hyperscaler spending? Are they just spending into oblivion, funding the balance sheets of every other company but not themselves as they go free cash flow negative? Turns out, actually, there's a business case for it, and their cycle reaccelerated through the growth rate. So that was answered as well. And so you've got the two major questions out of the way. And then the third is this an earnings bubble? And the answer is no, it is not, because you've got accelerated growth rates for the spenders. And that once you've answered that question, it's pretty much clear out there.
If there is a clearing event, and you've identified several, it seems to be benefiting everybody at the moment. And we're trying to figure out, when do we start to discriminate again? Because much of this year, you saw chips do well, but software react poorly. You saw an inverse correlation between the hyperscalers and the chip players at times as well. That's what ultimately blew up the likes of situational awareness, who were very long hardware and very short software, and things flipped pretty quickly in the last month or so. Where do you see things going from here? Where does the leadership come from? Surely you don't believe that everything in tech just keeps on rallying the way it has been.
No, there's definitely going to be more selection here. I mean, this was sort of clearing charts. Like, you went through 50 and 200 days in the last 2 weeks, which you really needed to do to clear the charts of the deteriorating, software companies. So we cleared it. I think for the most part, it's likely to be from the hyperscalers and less on the chips, in part because the chips have come so far, and there is that lingering question, what you quoted here, which I said, which is they're funding the balance sheets and the P&Ls of 20% of the S&P very clearly. And we know that markets trade on the rate of change. At some point, there's going to be a question, can you grow earnings 1,000%? Are you growing earnings 20% instead, which is still excellent, but it's not growing 1,000%. And there's a reason some of these chip companies are trading in the single digits, because the street just doesn't see this going forever. And I think that's where you're going to start to see the differentiation. You still haven't cleared the parabolas. That's an issue. So I think you're probably getting it to the unloved companies. And since November 1st of last year, that whole panoply of large cap tech has been terrible. It's underperformed the S&P. It's underperformed the Russell. It's underperformed international. It's underperformed emerging markets. And I think that gets reverted to here. I think the chips, while benefiting, and the investment cycle can go for a long time, 18 months more, 3 years maybe, who knows actually. Eventually the growth rate is going to slow on the earnings for those companies.
How much is the success on return on investment in the likes of hyperscalers and software going to come at the expense of OpenAI and Anthropic? And I say this because it could be a volatility-inducing event when they try to IPO, if they try to IPO, given some of the noise about exactly what this model looks like and how much of a moat they have over something that's increasingly open model.
Look, it's very unclear. I mean, there are many people who think the models are converging. So the latest for one LLM over another, they're starting to look very similar. And I think that is the question for those business models, right? Like, if you can't differentiate, then, what's the value? On the other hand, I know everybody uses all of them. And so they seem to be terrific. Also, if you just look at the revenue growth rate, I mean, the revenue is compounding for both those companies at an extraordinary rate. We're talking close to $100 billion for each, coming off of zero 3 years ago. So the revenues are astounding, compounding at an astounding rate.
So you don't?
I think they'll be successful.
Do you think that the doors are still as wide open for IPOs, for raising money in the equity and debt markets now as they were 2 months ago, at a time when there still is a huge bill coming for all of the build out here?
I think that we're going to have to see some of the lockups on some of the marquee IPOs to kind of clear the deck a little bit. You know, in the end, you want the IPOs to be successful and not break price. And if you break price within a week or two, that's an issue. And I think that's why you've seen a slowdown in the calendar, right? And then you have
because of SpaceX?
Because you have to get through the lockup. You have to get through the lockups here. I don't think there's too much capital coming to the market. The S&P is $60 trillion. I don't think the IPOs are too big. I think there's a massive wall of capital coming to this, not just in the U.S., but globally. You know, we're hearing from our iFlow team, there's massive, massive buying of U.S. equities globally, because where else are you going to go with that wall of money? Other markets are simply not big enough. So I'm not worried about the dollar amount, but there is that marketing thing, right, where you want it to be successful, and I think the markets have to calm down a little bit on the previous
Credit
IPOs.
to Alphabet for getting ahead of some of this. The additional supply, to your point, on SpaceX, Anthropic on the horizon, OpenAI. Just the reporting we've seen around OpenAI, potentially pushing things out to 27, maybe beyond, I don't know.
Yeah, and potentially because of some of the concerns around the capital raise with respect to their model, competitive pressure, et cetera. At the same time, it seems like a lot of people are pretty ambitious on their goals.
It looks like both are winning. Like, it looks like everybody's winning. You know, it doesn't look like one's... They're all winning.
You get a prize, and you get a prize.
That's what the last 4 days has felt like in the stock market, right?
I'll take it. You know, it's been a good change.
Alicia, it's good to see you.
Great to see you guys.
You're one of the best. Appreciate it. Alicia Levine there of BNY Wealth. Let's get you an update on news worldwide this morning. Back with us with your Bloomberg brief is Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump says a deal to reopen the Strait of Hormuz could be announced as early as today, with talks with Iran, quote, moving along very nicely. Axios reporting the US, Iran and Oman are preparing to announce a 60-day agreement on shipping through Hormuz. Blackstone is exploring a second mega debt package to finance Anthropic's use of Google AI chips. Sources telling us here at Bloomberg one initial proposal was for at least $36 billion worth of debt. If it were finalized, the deal would exceed the debt lined up by Apollo and Blackstone roughly 2 months ago. Uber shares down almost 3% at the pre-market, the company's gross bookings falling short of the high end of Wall Street expectations. Uber citing currency headwinds and fierce competition in international markets weighing on trip volume, which grew 18% nonetheless in the second quarter. And that is your Bloomberg brief. John.
Vonnie, thank you. More from Vonnie in 30 minutes' time. Up next on the programme, pushing the midterm agenda.
As far as the Republicans, they've got to get tougher. They've got to talk, and they've got to talk about how well we're doing. The food, the groceries, it's all coming down. We've done a great job. You know, I think we should be given an A+ on the economy.
Ariana Salvatore of Morgan Stanley joins us next, live from New York City this morning. Good morning. So 24 hours full of superlatives for this equity market. On the S&P 500, 4 days of gains again, very close to 6% over that period. On the Nasdaq, up by 1/10. Within the Nasdaq, some massive moves for semis and for the hyperscalers too. In the bond market, 2s, 10s and 30s shaping up as follows. Yields this morning slightly lower at the very long end. Still struggling to find many people who want to buy the 30-year. 30s are right now around 5.16, down a single basis point. As we've said repeatedly in the last 30 minutes or so, really interesting conversation with Ashok over at Neuberger, making the point, Ashok Bhatia, that he would prefer buying hyperscaler debt, 30-year hyperscaler debt, which, just thinking about that, Where's tech going to be 30 years? Never mind a year away. I've got no idea. He'd rather buy that than the 30-year Treasury.
Yeah, and what's interesting about this is that he actually thinks that there is a case for the Federal Reserve to be on hold. He doesn't think that the Fed should be hiking rates. This isn't a question about Kevin Warsh. And
no, he's bullish disinflation.
He's bullish disinflation, and still he won't buy the 30-year Treasury, which just gives you a sense of how much reluctance there is for people to have conviction behind Washington, D.C. and the fiscal picture going forward.
You mentioned Kevin Warsh. Let's talk about Kevin Warsh. This from Torsten Slok over at Apollo. I'll share the note, the morning note with you right now, and then we'll get into it. Warsh is right. He goes on to say, Fed Chair Kevin Warsh has been unfairly criticised. The decision to eliminate forward guidance isn't reckless, it's pragmatic. It stops policy inertia and restores real market signals. It ends false certainty. The bottom line is that Warsh's logic is sound. Cleaner data signals are better than false certainty, and the Fed gains flexibility. Torsten, you're a long-time friend. I would say this if you were here. Who's this for? Because no one really thinks that he's wrong for removing forward guidance. I've not heard that from many people at all.
I would argue people are trying to disentangle the gut aversion to the press conference and some of the commentary and the criticism immediately after that to what are the issues that are dividing us. And I think Torsten Slok puts his finger on it when he says this is a question of what is the cost for having a lack of clarity from the Federal Reserve. And in Torsten Slok's opinion, it is volatility. And ultimately, there are a couple of key questions emerging from this. Is volatility good, healthy for the economy? Does it kind of beat out some of the excess that could potentially cause easier financial conditions? Or is it a cost that is punitive? And I think that Torsten Slok's coming out on the punitive side. And the other question is, what is the better way to regulate inflation, the front end of the yield curve or the long end of the yield curve? And these are the questions that people are trying to parse out in the absence of hearing from Kevin Warsh.
What's the question you're trying to answer? I refuse to engage in this debate, and I'll tell you why. This is not the debate that the critics of Warsh are having. They're saying we're drawing a distinction between guidance and reaction function. He's not providing either right now. I'm okay moving to the going back to the pre-GFC world of a lack of communication. Park that. There's no argument over that. I don't hear anyone on Wall Street complaining about that.
Nobody is.
But I keep seeing piece after piece saying, stop complaining about the end of forward guidance. There is no complaint about the end of forward guidance.
I would agree with that.
It's a complaint about a refusal to articulate a reaction function at the top of the Federal Reserve when the rest of the committee are willing to do so.
How do you create an argument when you talk and try to create a distinction between forward guidance and a reaction function and people say you're a crybaby? Well, you try to come into what the ultimate debates are, which is volatility inherently good? Is it better to have the long end or the short end? And let's move away from calling people names.
It's impossible to have this debate right now because you're
Correct.
sort of complaining about one thing and they're like, you're an idiot, you're upset about this. And you're like, no, I'm not upset about that. It's about this.
I don't disagree with you.
We're going to do this all year?
Well, I don't think so because we are getting a reaction function from other Fed officials, and so at least there's that.
The president has offered his views on where the US economy is right now. He's got his own views on what it should be graded to. Under surveillance this morning, pushing the midterm agenda.
As far as the Republicans, they've got to get tougher. They've got to talk, and they've got to talk about how well we're doing. The food, the groceries, it's all coming down. We've done a great job. You know, I think we should be given an A+ on the economy, but I think that's coming. People are starting to talk about it. Our country is rocking and rolling. We've never been this successful.
Here's the latest this morning. The president touting the U.S. economy as midterm primary results roll in the crucial swing state of Michigan. The Senate Democratic primary between progressive Abdul Al-Sayed and Representative Haley Stevens still too close to call. Ariana Salvatore of Morgan Stanley writing, we think Democrats hold a slight edge, but the Senate map remains a major structural headwind. Ariana joins us now for more. Ariana, good morning. It's good to see you. How is the stage set for this economy into November, and what does it mean for voters at the moment?
Yeah, a lot of things to unpack there. Obviously, the economic picture is one of an aggregate of different indicators, right? So if you look at things like inflation, we're expecting more disinflation throughout the remainder of this year. If we look at things like consumption, the overall sentiment is not great. We're a little bit higher off of the low lows, but we don't think that really translates to spending intentions. We still see relatively robust consumption this year, around 2%. We just revised that up from 1.7%. You know, the labor market's still relatively sideways. So all of that paints sort of a decent picture for the economy. We call it a benign macro backdrop. That's not the only thing that matters to voters. Obviously, affordability a top concern. But aside from that, we see prediction markets, we see polling, we see the presidential approval rating. all signaling a more favorable environment for Democrats come November.
I remember thinking that Biden would get battered in the midterms into that November a few years ago, and it didn't happen the way people thought it would. What's the lesson from then, and how might it apply to this situation?
So 2022 was actually really similar to this midterm election. If you think about it, we had an energy shock in February of that year, right? And then the structural, the map, the Senate was really what was important in that election. There were some anomalies. Remember, we had the Roe v. Wade decision leaked, which energized turnout among specifically women and college-educated voters. So I think that is what allowed the Democrats to maintain the edge. But back to the structural sort of dynamics here, the map is really important. And with this progressive win we saw in Michigan last night, that makes it really challenging as a general election seat for Democrats to flip, right? And that's going to be kind of the key point between Michigan, North Carolina, Georgia, races for November.
What are the main issues? And I'm thinking specifically of the hyperscaler build out and some of the energy plants and this concern about the cost of living that could potentially be tied to artificial intelligence. How much is that present in some of the discussions with constituents?
Extremely present. And this is probably the biggest wedge issue heading into the midterm elections, right? We know AI is unpopular. We know specifically among younger voters. So 18 to 29, something like 60% are worried about job displacement. But when we look at the data center build out specifically, the concerns are really threefold. So first is quality of life, right? So no one likes to see large scale construction in their neighborhoods. Second is around water usage, which we find to be a little bit less well-founded than some of the other concerns. And then, of course, electricity inflation and what you're paying for your utility bill. That is more a phenomenon on a regional level rather than national, but it's certainly part of the discussion and part of the reason we're seeing this real political constraint in building out these data centers.
Well, so how much of a political constraint will this be? Because so far, the White House has been behind a lot of these efforts and saying we have to maintain a dominant edge. How much will it constrain some of those policies that have enabled the build out so far?
So, look, we think there are ways to mitigate it. We think there are certain concessions that hyperscalers and other companies can offer these communities, whether that's, bonuses to local community engagement, or whether it's some sort of a large load tariff or commitments to grid modernization. We think there's enough they can sort of promise and provide to facilitate the build out, but that's importantly why we think it's conditional. We don't think this is going to be a uniform kind of one size fits all approach across the country. And what that leads to is basically a bifurcation between regions that allow data center development and regions that do not.
Is the left tripping up on the national stage? Are you seeing sort of the highly progressive members, and I've seen a few in the last 24 hours, struggle to articulate their view and being sucked into major issues that have nothing to do with local ground issues? Have you noticed the same thing?
I think what you're seeing is an amalgamation of concerns among the voter base. And right now, if you look at the Democrat Party, there's no clear front runner for leadership, right? So we don't have a clear person that's ahead of the other candidates when it comes to even the 2028 election. So I think Democrats are right now going through a really important phase of sort of self-discovery, right? So figuring out which policy paths are the ones that are going to resonate with voters. And remember, this is an election that's the pretext to 2028. So this is the important time to sort of have those debates and those discussions. I think it's experimentation, and we'll probably see it on the Republican side as well once Trump steps back.
Ariana, it's good to see you. Thanks for being here. Ariana Salvatore there of Morgan Stanley. I've noticed the same thing. I've been seeing this play out. I understand that the issue right now is affordability. So why is the debate about the situation in the Middle East? Why is that such a key feature of the views of certain individuals running for state-level politics? Why has that become one of the key issues?
This is a real question for the Democratic Party, and I do think that the Michigan primary is going to result in a general election that's going to be a tell for exactly how viable some of the Democratic Socialist candidates are going to be come the fall. I mean, this is going to be a real question. Ultimately, my one question is, who cares about the deficit? Which party is going to come out and say, we need to stop issuing so much debt, we need to curb spending so that we can fix all of those people who don't want to buy our 30-year debt?
So you're half joking, but you've touched on the issue with regards to the deficit. Only when that actually becomes an issue that buys votes,
correct,
will it be an issue that's dealt with. And it's nowhere near to becoming that issue.
I talk about it every night with my kids, and they don't seem to care. They, in fact, shut their ears. But, I'm becoming my grandfather who said, the deficit. But this is going to be a real question going forward for a lot of different market participants.
You actually debate this at dinner time?
I try to make them interested.
Do you really?
I do.
I
try to tell them that they have to play an active role in understanding the financial backdrop
Well,
of
the
our
oldest
country.
is into the bond market, so,
Even he shows, totally tunes me out.
He's more constructive. He's less sort of bearish on things.
Yeah, at this point, he's like, Mom, it's August.
Right, OK, fair enough. But you're trying.
I do. I think it's important for them to be active participants and knowledgeable.
The next
generation.
The next generation of fiscal hawks.
They're gonna adopt a very tough situation, and I want them to be savvy.
Up next, Brian Whalen at TCW on Wall Street's massive push to unload billions in AI data center debt and what the Bramo family has got to say about it. Equity futures this morning up nicely, up by another 0.4%. What a rally we've seen in this market. Biggest one-day gain going back a number of months on the S&P 500. A four-day rally of close to 6% on the S&P, and a major move for some of the biggest companies on the planet. On the Nasdaq this morning, up by 0.14. Record high on the S&P, record high on the equal weight. In the bond market, 2s, 10s and 30s. Data yesterday on the headline, job openings a bit softer. Beneath the headline, to Lisa's point, things were a bit firmer. Hiring was okay, quits weren't too bad. All of that points to a labour market that's still doing all right going into the jobs report on Friday. Yields this morning around 460 on 10s, 420 on 2s, north of 5% on 30s, and a big conversation on this programme all week and in the last month or so about what it would take for the buying to come back in.
Is this really just a matter of the Federal Reserve and questions about their commitment to potentially raise rates in the face of inflation that's above target? Or is this an issue of the fiscal overhang, of a question of competition for capital, and a question of a global story where we're seeing yields in the long end creep higher? And if that's the story, it's going to be more than the Federal Reserve. It's going to take the attention of people in Washington, D.C. to maybe make a real difference when it comes to the real yields on some of that longer-term fixed income instruments.
You've got a massive competition for capital, persistent 6% budget deficits in this country, and a Fed chair that's open to the idea of letting yields run. And on top of that, more recently, the prospect of spillover risk out of Japan. It's a long list of things to worry about if you're the Treasury Secretary right now, which speaks to why he's been so active in the past few days.
Yeah, and possibly why he's gotten an opening to be active in this way, particularly with the dollar potentially taking a hit in the face of some of these concerns. I do wonder, though, if you do get people coming back in, if you have a Fed that hikes rates, or if this is something more existential that requires the attention of someone down there.
Lisa, everybody, raising the next generation of fiscal hawks down in Washington, D.C.
Actually in New York City, but maybe they'll head
Thank you, Bramo.
Anytime.
Thank you for your service.
I don't know if it's actually sticking, but I'm trying.
I'm not sure if that's because they're going to fix the issue or just be aggressive bond bears when they're older. Whatever it's going to be great to watch.
Yeah, well, thank you. I appreciate that, hopefully.
2 hours away from the cash open. Let's get you some single names, some stock moves this morning. Yahara has more. Hey, Yahara.
Hi, John. We have a flurry of earnings to get through, and all reinforcing this idea that we have a very strong earnings season underway. And we start with Eli Lilly, shares up nearly 5% in the pre-market after the drug maker gave investors exactly what they were looking for, and then some. It beat on earnings and revenue, raised its full-year sales outlook, and the launch of its new obesity pill is off to a very strong start. That is especially notable because Novo also came out with one, launched one last week, and it didn't go as well. So Lilly remains the one to beat in this obesity drug race. Turning to Disney, those shares up nearly 4% in the pre-market after its biggest businesses, entertainment and experiences, delivered. Streaming keeps getting more profitable, and in a testament to consumer strength, the parks business saw strong attendance and spending, all of that contributing to a solid earnings per share beat by Disney. And we are seeing Shopify shares surging 25% in the pre-market after delivering the kind of quarter investors had been looking for, especially amid the sour sentiment around software, which had led the company to fall 20% year to date heading into its earnings. The e-commerce company beat estimates across the board, though, with revenue growing 34%. It expects growth like that in the coming quarters as well. Merchant sales also topping expectations. John?
Yahara, thank you. More from Yahara in the next hour. On our radar this morning, the president claiming a deal to reopen the Strait of Hormuz could be announced as soon as today. Axios reporting the US, Iran and Oman are preparing a 60-day agreement on shipping through the waterway. Elsewhere, shares of SpaceX sinking in the pre-market, higher than expected spending on AI outweighing a strong earnings report. The CEO, Elon Musk, doubling down on the company's plans, expecting the, quote, cadence of AI development to accelerate dramatically. Stock is down 12%. And finally, Ken Griffin's flagship Citadel fund surging nearly 6% in July, thanks in large part to its purchase of a discounted AI stock portfolio from the hedge fund Situational Awareness. The transaction helping to boost Citadel's year-to-date gains to 12%.
How about this for a statistic? That fund had only been up 0.45% as of July 24th for the month. And then it ended up about 6%. So it gives you a sense of how much they gained on the other side of this. I keep going back to Ken Griffin's reputation as sort of the grim reaper of people who are failing in the face of high leverage. And it just shows how this shakeout has really caused some winners, even if you have seen situational awareness become strategic ambiguity.
And nice work if you can get it.
Exactly.
There was a quote that I saw from Kenny G more recently, which is good things come to those who wait, but only the things left behind by those who hustle. And that kind of speaks to Citadel and Ken Griffin pretty well, I think.
It also speaks to their balance sheet, that they have the capacity to do this at a time when other people might not. Again, it goes to the underlying question, is situational awareness an anomaly or a representation of more pockets of leverage and excess that need to be worked out in the next couple of months?
This market moved pretty quickly in the last month. Lots of debt coming to market too. It's a big theme for this programme. Wall Street pushing back on AI's massive borrowing boom. The Financial Times reporting a group of banks are planning to offload $15 billion of debt tied to a Google-backed Anthropic leased data centre. Brian Whalen of TCW writing, cost of capital is rising and hyperscaler spreads are significantly underperforming. It's still hard to see winners and losers in this arms race. Brian joins us now for more. Brian, good morning. It's good to see you.
Good morning. Thanks for having me.
I want to give you some time just to sort of paint a picture for our audience. How much this market has changed in 12 months with the increasing involvement of these massive tech companies?
It's like, close to 30 years in the business, like nothing I've ever seen. Basically, these financing arrangements for these data centers have gone from 0% of issuance in the debt market to about 20% in the corporate bond market today. And the point we're trying to make is that, traditionally, just supply-demand in anything, but in the bond market, supply-demand. An issuer or a group of issuers in an industry come to market and they borrow a lot of money, and eventually it's too much. And the bond market says, whoa, that's too much. Instead of charging you 5%, we're going to charge you 6%. And then the borrowing goes down. Instead of 6, we're going to charge you 7. And eventually you just choke off that borrowing, and the laws of supply and demand just kind of settle in. In this case, you're talking about the largest companies in the world, these hyperscalers, and their balance sheets going into this were pristine. You're talking about the U.S. government and what happens to the long end of the curve because of fiscal responsibility. Like, these balance sheets are rock solid, and they can absorb this debt. And when you say to them, when the market effectively says, whoa, you've borrowed $250 billion year to date, that's too much. We're going to charge you not 5, we're going to charge you 6. Oh, wait, we're going to charge you 7. You know what they say? We don't care. Because the extra cost to borrow that money, it's not the cost of the capital that's important to us. It's just getting that capital. And we've never seen that in the bond market. And so what I would say is, initially 18 months ago when these deals started to come to market, they'd come with a little extra spread and investors would get excited. And now as spreads have gone wider and or yields have gone higher, the bond market is getting very soft. And I'll give you the stat here, and we can talk maybe about not just these unsecured deals, but the security structured deals. But with regards to the issuance, these are the most pristine balance sheets in the world. Year to date, the average spread on the corporate bond is unchanged. 72 basis points over Treasuries. We're pretty much unchanged. This hyperscaler group, your Microsoft, your Googles, your Metas, your Amazons, 50 basis points wider. 50. They used to go trading from tighter than the average corporate bond to much, much wider. And we've never seen that. But again, as you're going to see, they keep coming to market.
Do you think we're close to the point where that additional supply, other people have to pay the price for it too? To your point about how things have been priced, hyperscaler debt relative to what IG spreads have done, are we at the point where this starts to blow out spreads at the index level?
Not yet. And what I would just say is the metrics I would give you, it's a higher cost of capital, these hyperscalers, but because the index is unchanged, if you're doing something else, if you're running a waste management company or you're doing something in cable, you're still operating at about or borrowing at about the same levels you had when you started the year. However, it has set the market up to be vulnerable to something else happening that we're not seeing. And so I would say if it's a slowdown in the economy or a recession, or maybe something fundamental in this AI trade kind of takes a turn that no one's expecting, because there's so much supply and the market feels vulnerable, it's probably more susceptible to much higher borrowing costs across the economy.
If I'm selling a bottle of water and we're on a desert island and that person's going to give me everything that they possibly have because they need that bottle of water, well, I would charge everything.
Yeah.
Why not just charge 10%? Why not just say we're going to boost the spreads to such a degree because you're still going to keep coming? What's the obstacle from spreads going that much wider on hyperscaler debt? Because it seems like a price-insensitive buyer. That is time to say ka-ching.
Yeah, I would say this. First of all, that's a great point. I'd say, in the last few years, there's been an influx and a much bigger presence of like insurance money, in the market. And so I would say the good news for the hyperscalers year to date is that there's much more interested money that can not just look at spreads, but they look at all-in yields. And so while we've had this increase in issuance, which has widened spreads, because of other factors, primarily what's going on with energy costs, yields are higher. And so some buyers out there, a lot of these insurance monies, they're not really necessarily looking at spreads. They're just like, what is my all-in yield? And so it's been attractive to them, and they've stepped in to absorb it.
We were talking with Ashok Bhatia earlier. We keep referencing this conversation. He said he'd rather buy this hyperscaler debt, 30-year hyperscaler debt, than 30-year government debt in the United States. How common is that?
I agree with the statement. I would say, the issue first of all, you were talking earlier, like there's two issues in the bond market. On the long end, it's the fiscal issue, and that's going to have what happens with the 30-year. In the short end, the 2-year and the 5-year, that happens. The concern there is what's the Fed going to do with inflation, et cetera. I would say, kind of word of caution is that these 30-year hyperscaler debt, first of all, you've got the debt that they just issue off their balance sheet. Traditional bond debt, that looks attractive. It's wider year to date. Then you've got close to $400 billion in the last couple of years of this structured debt that comes with a lot of different bells and whistles. It comes with a lot of risk. You're selling liquidity. There's a lot of complexity to it. And yes, you're getting extra yield premium. But if we hit this squishy point in the marketplace, you could see that start to unravel, and there could be quite a bit of selling and dislocation.
We talked lots about companies. You mentioned spreads.
Yeah.
You mentioned all-in yields too. We've talked about this a number of times on this programme. All-in yield is pretty attractive for a lot of investors right now. And within that all-in yield, there is this very small corporate credit spread. The bigger and bigger proportion of that all-in yield is the Treasury.
Yeah.
And from what I just heard from you and heard from another guest earlier this morning, is you believe the risk might be there and not here. Can you just walk us through that, why people would be willing to pick up this credit at minimal additional spread and step away from the Treasury? Because we're struggling to find people who like the long end of the Treasury curve. What is it about Treasuries right now that is so unappealing?
Well, the thing with Treasuries, particularly in the long end, it's regarding the fiscal question, right? And, this week we heard that there's not going to be any real change in coupon issuance, but the market's concerned that that's going to go higher, and inevitably it will be. I mean, I'll just give you a stat here. We just crossed, this fiscal year, the U.S. government's going to pay over $1 trillion of interest costs. That's 3.3% of GDP. That's up 3 times from where we were in 2020. So there's a real concern, and the term we're looking for in the bond world is a steepening. That maybe the front end of the yield curve is going to stay anchored close to where the funds rate is, which will be determined by kind of near-term economic and inflation prospects. But the long end, that could become unanchored based upon fiscal situations. And so that's really the concern. Like, the 30-year is going to be driven in large part upon where the deficit goes. What I would say, though, with regards to spreads, I would say that is kind of a short-sighted approach from investors, accepting very minimal extra yield over Treasuries. And the reason I say that is as typical late cycle behavior. You kind of get into a cycle, there's a lot of euphoria, and people are willing to be paid very little to take that extra risk, and not only paid for the extra credit risk, but offer selling the liquidity.
You described this as late cycle, and I want to pick up on that and tie it back to what you were saying with some of the structured products that are making you feel like a lot of bells and whistles, very creative.
Yes.
Do you think people are getting to the overly creative stage? This is something John was asking about yesterday.
Yeah, I appreciate it. Let me just going to break this down to 2. This is how typically hyperscaler debt. It's Google, it's Meta. Okay, let's look at their balance sheet. Let's underwrite it. Very little leverage. I'm willing to take very little compensation over Treasury. That's probably the right way to look at it. This structured debt, okay, it is very unique and it is very creative. And our friends on Wall Street, they can create very interesting products. So 2 primary risks in this situation. So unlike a traditional hyperscaler debt corporate bond, you have 2 risks. First, you have construction risk. So you lend this money in these big deals we've seen come out, Beignet and other things like that. and there's a construction period. And here's the thing. Construction, whether you're building a home, an office building, or a data center, it could take too long or longer than you expect, or it could cost more. And so while you may lend money thinking, oh, I've got Meta on the hook for the lease payments once they come in, there could be 1 to 2 years until Meta comes in. And so who is going to cover the extra cost if it occurs? If it's Meta, great. And those bonds have come out and usually get investment grade ratings. However, usually who covers that cost are the owner of the property that you've never heard of, or the construction company, which may be investment grade, maybe below investment grade. So that's the first period you have to get to. Once that's done and construction's completed, you're like, as a bond lender, you're like, okay, whew, I'm ready to move on. Now I got Meta in. What the market's really starting to focus on now is Meta at the corporate level guaranteeing those lease payments? Or, and this is the nuance, in some of these deals, these large hyperscalers are not the direct lessee. There's someone in between the property and them, okay? And so the question is, first of all, even if Meta is guaranteeing that, or others hyperscalers, how are they accounting for that in their balance sheet? These kind of once-removed situations are typically not recorded as operating leases, which your first-level CFA analyst can understand and account for. A lot of times they're buried down in the footnotes and maybe not called what you would expect them to be called, and they're not the number is not exactly what you would expect. They're kind of discounted, and so there's a risk there. So late cycle behavior. Sometimes you got investors who can underwrite this entire kind of life cycle of this investment and understand the risk and price it appropriately. But to your point on late cycle behavior, often because these bonds are offering extra yield, you get a lot of tourists in here, and we don't think that a lot of these participants understand these full complexity of risks. And I'll end with this. If this AI journey takes an unexpected turn, these bonds, $400 billion of it, if they are held by some tourists and we hit a bump in the road, you will most likely see massive selling in this area, which could make cheap bonds even cheaper. And so from our perspective, there is some interesting bonds to buy. We've been dipping our toes in the water, but for the reasons I've articulated, we're going to wait here a little bit because we think they're more likely going to get cheaper before they get more expensive.
The downside of live TV is ending conversations like this one because of time, Brian. Appreciate it. Thank you.
Thank you.
A lot to go over there. Brian Whalen there of TCW with an update on news worldwide. With your Bloomberg brief, here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thanks. Oil rising as Yemen's Houthi rebels renew threats against Middle East shipping. The Iran-backed militant group saying they'll escalate attacks on Saudi vessels in the northern part of the Red Sea, an important alternate route to the Strait of Hormuz. Shares of Prudential and HSBC are tumbling in London trading after China expanded its tax rules. Mainland authorities are now hitting Hong Kong policy returns with a hefty 20% tax rate. An out-of-control SpaceX rocket colliding with the moon, hitting it with the power of 3 tons of TNT. The crash leaving a crater behind on the surface. Scientists will study the crash to understand safety risks they might pose for any astronauts living there in the future. That is your Bloomberg brief. John.
Hey, Vonnie, thank you. Up next on the programme, restoring inflation credibility.
The Fed's walking a very fine line here.
The chair will look increasingly isolated from the rest of the committee.
We're banking on the rest of the Fed trying to reestablish some of the inflation credibility.
Up next, Collin Martin of Charles Schwab. Equities this morning up another 0.4 on the S&P. The Nasdaq just about positive by 0.25%. Under surveillance this morning, restoring inflation credibility.
The Fed's walking a very fine line here.
The chair will look increasingly isolated from the rest of the committee.
I can't imagine a situation where the chairman allows himself to be outvoted by the committee.
We are so grateful for those Fed speakers who are willing to explain their reaction function.
We're banking on the rest of the Fed trying to reestablish some of the inflation credibility.
So here's the latest this morning. The Kansas City Fed President Jeff Schmidt calling for tighter monetary policy to tame inflation. Investors looking for clues from Fed speak this week on the central bank's next move. Collin Martin of the Charles Schwab Center raising his expectations for the 10-year yield to 4.75, writing, with any potential rate hike likely to offset last year's so-called insurance cuts, long-term yields should remain elevated. We see more upside risk than downside risk with long-term yields. Collin joins us now for more. Collin, you are not alone. Good morning.
Morning.
The aversion, the visceral reaction we have from people when we ask them, do you want to buy 30s? Even if they see a path for disinflation, the pushback we've been getting is quite remarkable. When does it become a screaming buy?
Yeah. Well, actually, if we're talking long duration, I'm more interested in tips. But we're not there just yet. You have to acknowledge that when you buy a long-term investment, specifically something with 30 years, it's very risky, just over the short run. So that's something that we're always considering. But at some point, we think these yields will look a little bit more attractive. We're just not there yet. So we've upped our outlook for long-term yields, but we acknowledge there's more upside risks than downside risks. So we're thinking about the potential experience from our clients at Schwab if they were to go buy a 10-year or even a 30-year, and then we see the 10-year test 5% or the 30-year test 5.5%. It's a bad experience. We'd have to explain, obviously, there's a difference between short-term price fluctuations if you're a buy and hold investor, but we're just not there yet. Also, we just don't think anyone's going to miss the opportunity. You know, we think we're in this higher for longer era right now, and we think yields are going to fluctuate for a while. If you look at the 10-year over the past 3 years, a team at Schwab, we were talking about this yesterday, it's held in this tight range for about 3 years now, and we just think that might continue. So rather than having to do it now, we think there could be opportunities if they continue to increase, or once we get a little bit more clarity about what that path of Fed policy is, and that's a double-edged sword, clarity on Fed policy.
Well, hold on one second. Is this an issue of Fed credibility and Fed action or inaction, or is this an issue of the deficit?
The deficit hawk right here.
I'm trying.
No, I think it's a little bit of everything.
Because there's no one else.
I don't think it's a credibility issue. It's all we hear about these days. I think it's too early to say that. You know, after last week's press conference and the lack of anything you can say from Kevin Warsh, we saw yields rise about the credibility issue if the Fed isn't prepared to act. We don't know what his reaction function is, but we know what everyone else's reaction function is, or at least a number of the members. We just saw the quote from Schmidt this morning. We heard from the 3 dissenters. I really liked the way John Williams laid out his path of what we need to see. So credibility, I think it's too early to say there's no credibility. If we were to go on a few months or quarters and we see this still sticky inflation or maybe higher inflation and the Fed doesn't do anything, then we can talk about that. For now, I don't think it's credibility. I think it's inflation. I do think it's deficit to a degree on the long end. Historically, we haven't found much of a relationship there. Add that all together, though, higher rates at the long end.
What would you rather buy right now, Hyperscaler 30-year debt or U.S. 30-year debt?
I'd still buy the 30-year. I heard the conversation before. Right. At the end of the day, if we're thinking about long-term debt, are we worried about inflation over that period? Are we worried about the value of the dollar? If you're in hyperscaler debt, you're still holding dollars right there. In terms of a credit quality of the government, obviously we have these fiscal concerns. I think I'm still comfortable lending to the government right now. So over that long time frame, I'd probably focus on that.
Do you remember the rapid-fire round of the real yield show?
I was literally thinking exactly of that.
That is the perfect.
It was such a good question for that.
That's the perfect question.
I was thinking of you.
Went.
I was thinking of the real yields.
That's fantastic.
Would you rather?
Would you rather 30-year hyperscaler debt or 30-year treasuries?
I like that.
And when you ask them about 30-year treasuries, they're like 30 years is a long time.
Yeah.
For treasuries, the US government, probably going to be around in 30 years. 30-year hyperscaler debt? Got no idea if these companies exist in 30 years.
There we go, same page.
Right? It's kind of crazy.
Well, and also, you have to imagine you're still incurring the risk of the U.S. government, as you were pointing out, in addition to the risk of hyperscalers. At the same time, yield, it looks pretty good. I mean, the idea of 7% yield to get on investment-grade credit or 6.5% yield is enticing. So you have to balance the number of people who find that enticing with the number of people who are saying, I just want to scrutinize this document one more time. Exactly. How are we going to get there?
Yeah, for good reason. Collin, it's good to see you. Thank you, buddy. Appreciate it. Collin Martin there at the Schwab Center for Financial Research. Up next, Monica DeCenso of JP Morgan, Andrew Honhorst of Citi, Nisha Patel of Parametric, Noah Weisberger of BCA Research. The third hour of Bloomberg Surveillance just around the corner.
Earnings season has been pretty stunning.
This might be the peak of earnings.
Maybe 27 earnings are at their peak, and that could be the cause or maybe usher in more volatility for risk assets.
We've seen multiple companies up the CapEx spending that they have and get punished for that.
What is the market looking for? They're looking for that ROI.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern. This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern. Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern. Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern. This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern. Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern. This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern. Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern. This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern. Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern. This is Bloomberg Surveillance with Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. And your scores, the price action looks like this. Up again, adding some weight to the rally. 4-day winning run, higher by close to 6% over that period. This morning, higher by 0.4% on the Nasdaq, up by 0.2. Two names lagging this morning. One is SpaceX, the other is AMD. SpaceX is down by more than 10%. AMD down by 8%. Earnings underwhelming at AMD, spending concerning over at SpaceX, but we're shaking that off. And the conversation moves from earnings now to the economic data. Check out bonds, 2s, 10s and 30s. Yields this morning, just a little bit lower at the long end, unchanged on 10s, 461.27 on 10s, 30s of 516 and 2s, pinned around 420, heading into this, about 14 minutes away. ADP data, then it's on to the ISM later this morning, then it's on to payrolls later this week.
At a time when potentially there's greater volatility around some of this economic data, simply because there isn't a clear sense of exactly how the Fed is going to assess the incoming data in order to decide whether or not to hike rates. The labor market seems stable, although Citigroup's Andrew Hollenhorst put out a note earlier this morning talking about the JOLTS data, highlighting that churn, that low hire, that low fire type of dynamic that leaves us with a big question mark about how much inflation can potentially come out of the system tied to the labor market.
Andrew joining us later, suggesting that maybe some labor market weakness is on the horizon, together with the disinflation they're anticipating. They still believe this Fed can cut this year. It's a big call when a lot of the street right now, the overwhelming consensus is at some point between now and December, they're hiking rates.
I'm channeling Mark Cabana. You can't fool the bond, and you take a look at what's going on in the 30-year, and it seems to be saying that there are still concerns about just how disinflationary this market really is, or how rather inflationary it could be. Hard to parse, though, what we're actually seeing with the long end of the yield curve, as we've seen repeatedly throughout the morning. Nonetheless, this is going to be the debate. Is the Fed potentially going to have the room to remain on hold, not even to cut, but to just remain on hold based on some of the message that the market's saying, and frankly, other Fed officials?
There's a lot of runway between now and the September meeting. A few more payrolls reports, a few more CPI reports, a Jackson Hole meeting. We've talked about that. You'll be there at the end of August. This story can change a lot in a few months' time.
Yeah, a few months of data is going to make a big difference, and exactly how much markets regain steam after the washout of situational awareness. I keep wanting to call it the other name just because it
Where did that come from? Strategic ambiguity.
Every time I say situational awareness, I have
you
to
just think of strategic ambiguity.
Yeah, it just automatically. I don't know, free association. I mean, it kind of was strategically.
You could start a fund called Strategic Ambiguity.
I think I'd raise
aggressively short bonds. That's what you want to do.
I think it would raise a lot of money.
Bramo, I have no doubt you'd raise a lot of capital.
$10.
All right. I'll throw $10 in.
Thanks.
All right, we'll make it happen. Coming up this hour, we'll catch up with Monica DeCenso of JP Morgan Private Bank, with tech driving stocks to new record highs. Andrew Hollenhorst of Citi reacting to the ADP jobs number in just about 12 minutes' time. Plus, we'll speak to Nisha Patel of Parametric, saying it's a good time to buy bonds. We begin this hour with stocks extending gains past all-time highs following their best day since April. Monica DeCenso of JP Morgan Private Bank seeing more room to run, writing strong earnings growth means valuations are lower today than where they were at the start of the year. The market isn't just cheaper than where we started the year, it's cheaper than 5 years ago. Monica joins us now for more. Monica, good morning. It's good to see you. How explosive, positive has that earnings story been?
It's been really interesting because a year ago, everyone was saying to me, oh, it's just the Mag 7, right? It's just tech. And now we're seeing broad earnings strength, but you're also seeing broadening below the surface, where you're seeing most sectors now posting double-digit earnings growth. Really interesting this quarter. I think it was 7 out of 11, posting 9% plus revenue growth. So it's like it's top line, it's bottom line. Margins are expanding. Like, it is actually a very broad story, in spite of the fact that it still feels like a hated rally. And I get that question constantly. How can we be here, given all the noise? It's because of earnings, and that is the single best indicator when you think about when to buy equities. Earnings momentum, swinging higher still. You still want to be.
Is there a sentiment indicator in there as well for you? The fact that it's still such a hated all-time high?
Absolutely. I mean, it's the sentiment when I talk to people, so I feel that, the vibes, if you will. But then I still look at portfolios. Cash balance is still more elevated than I would argue they should be, and where clients tell me they want to be. So that's why every time you see these dips, I know what my clients are doing. They're adding and trying to get a little more exposure because they don't want to miss out on maybe not the next 40%, because I don't think we rally the way we have, last couple of years, but still 5, 7, 10% over the next 12 months. So that's still a pretty interesting return.
Cash on the sidelines. That is a triggering comment for a lot of people. They say that's not actually true. It's not on the sidelines. It's invested maybe in short-term bonds, and then you're getting paid for it. So it's not necessarily on the sidelines. What is spurring people to want to move out of cash-like funds that are giving them income into, say, stocks? Right? What's still pushing people in that direction?
It's a couple things. I mean, one, there still is a bit of that FOMO, right? People see these returns of 13% year to date, and they say, okay, yeah, 5% feels good, but gosh, I could have just bought the S&P and made a lot more. But it's also about what are your goals? And if your goals, you're trying to compound wealth at like a high single-digit return, which is what most people need to do, you're not going to get there with cash. And so I have this continued conversation with our clients of where are we trying to get, reminding them, especially if you're worried about inflation, that cash is not going to work for you in an inflationary environment. I keep hearing the biggest concern my clients have, what if rates are higher? What if inflation is stickier? What if it stays here longer? That's not what you want to own if that's what you're worried about.
So is the stock purchase that a lot of people are making actually an inflation hedge? Is that increasingly where people's minds are?
To a degree. And then that goes to the next conversation of, well, okay, but you also get very nervous when the market gets bumpy. So are there better things that we could own, maybe have lower volatility but perform well in an inflationary environment? Then you have a conversation on real estate, infrastructure, hedge funds. Like there are a lot of tools that have been left behind, if you will, the last few years because they haven't made sense. Yeah, there you go. That could be.
Done quite nicely in the last month or so.
Yeah, it's nice to be the Grim Reaper.
A notable blow-up in the last month. Some people have come on the programme, we're talking about situational awareness here, and indicated that was some kind of clearing event to set the stage for the rest of tech to start running again. How do you see that moment?
I think it's tough to say whether that was a clearing event or not. I do think, again, it's healthy to see the market digest, the market to rotate a little bit. You know, we've seen some of these tech names bounce significantly, others still lagging. So I like to see that dispersion because that tells me the market's behaving more rationally. But I also just remind people, like, most of my clients probably own too much tech. They own a lot of it in the public side, they own a lot of it in the private side. So then you say, okay, if you still want to own risk assets, where is their earnings momentum? And we talked a bit about financials, saw an inflection point this quarter. Healthcare, we think, is going to inflect into 27, go from negative earnings to positive next year. Like, those are interesting areas to think about, especially with healthcare. It's a good diversifier to tech. So if you maybe own too much tech, it's
rotate away from tech right now, which piece of tech would you rotate away from?
You know, I just look at where my clients have too much exposure. You know, we still like the hyperscalers, but I probably have a little too much on there. So we've been taking some off there and then looking again, what has underperformed in tech? You look at semis, you look at parts of software. Cyber stands out. Like, AI is changing everything. It's making it a lot easier to have data breaches and for the bad guys to do what they like to do. And so I think when you think about software, what's sold off, that seems like an obvious area to think about.
You work with some of the wealthiest families out there, with family offices and other types of single individual and group investors. How worried are they about the political backdrop and some of the tax overlay that could potentially be coming to the fore as they decide where in the world to invest?
It absolutely is a concern because when you're talking individuals, most of mine, U.S. taxpayers. So they think about it, they worry about it. I then have to remind them, do not panic ahead of the election. Midterms, we're probably going to see actually a balance of power, which is a good thing because that means probably nothing gets done. So that's our view right now, and that's usually a green light for markets. We looked back at prior midterms. You generally see markets rally after midterms. It's actually like high single, low double-digit returns over the last 40 years. Now, I don't know, again, we're coming in from a period of exceptional strength. So maybe it's not that much this time. But I do think, if anything, this is probably a midterm where you see less get done over the next couple of years. Going into the next administration, that's going to come up again. Big questions I always get, laws about munis, prefers, things like that. I just don't see any of that changing now if you see the power kind of moderate in November.
Does it change the balance of where they're interested in investing?
There's been definitely a shift with concerns about U.S. debt levels rising for my U.S. clients to look more overseas.
Wait, they care about the deficit? Sorry, carry on.
They say they do. Yes, I certainly get the question a lot, and they have been more open, I would say, the last few years to investing overseas. Coming out of COVID, I remember saying to people, "Do you want to look at Europe? Do you want to look at Asia?" Nope. We think the U.S. is best positioned coming out of this pandemic. They put all their money back in the U.S. Ended up being a good trade. Now they're more open to having a dialogue around European equities, Asia. And what's really interesting, they're willing to sometimes hold those in local currencies, so diversify a bit away from the dollar. And I think that's the same story of this long-term concern about deficits.
Monica, welcome back anytime for an extended segment.
Of course.
I'm sure Lisa will be very happy to talk about the deficit.
I think we could dig in. We could talk about
The
specifically
dollar bear
where.
market.
Yeah, well, you know, look, I'm not calling for that. I just think that at a certain point it's going to matter. And the reason why I talk about it to my kids at night is because they're going to be talking about it to their kids at night when they have little infants. They're going to care about it. And at a certain point, when you have interest payments that cost the same amount as the Defense Department, you're going to start to wake up and notice. And when that suddenly also consumes all these other potential entitlements, then all of a sudden people are going to care.
They will have to care about it because they'll be paying for it. That's the problem.
Kind of my point.
And they'll be getting less back.
I know.
Less and less back.
You know, I'm kind of cringing listening to myself because I really do sound like my grandfather.
For good reason. for good reason.
Maybe.
Monica, it's good to see you. Thank
Thank you.
Appreciate it. Monica DeSenso there of JP Morgan Private Bank with an update on news worldwide this morning with your Bloomberg brief. Vonnie has more. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump says a deal to reopen the Strait of Hormuz could be announced as early as today, with talks with Iran moving along very nicely. Axios reporting the US, Iran and Oman are preparing to announce a 60-day agreement on shipping through Hormuz. Citadel's flagship fund surging nearly 6% in July after the firm bought a portfolio of AI stocks from troubled hedge fund Situational Awareness. Sources telling us here at Bloomberg the transaction helped boost Citadel's year-to-date gains to 12%. AI models by OpenAI and Anthropic revealing more unsanctioned actions during security tests, including hacking a website and attempting to inject harmful code into software. The UK government's AI Security Institute saying both engaged in sustained, potentially harmful activity directed at real people and organisations during evaluations. And that is your Bloomberg brief. John.
Bonnie, thank you. Thank you very much. Up next, some ADP data for you, plus Andrew Honhorst of Citi here to react why this Fed can still cut interest rates this year, according to Citi, in just a moment. From New York City this morning, good morning.
When do you start to see the monetization switch? And investors are basically betting near-term pain for long-term gain. But there is a push-pull point. You have to show it. You can't just talk it. You got to prove it, because it can't be the dog ate the homework every quarter.
Did we find out if he's in a yurt or not?
I
thought it was a hotel because of the fire exit sign in the corner.
Yeah, but it looked like a hotel in like one of those natural habitats.
Can you see Dan at one of those hotels?
He's probably in Southeast
like
Asia.
the middle of nowhere?
Yeah, probably. No, with like an elephant
with,
outside.
Bears jumping through the water and stuff. That's where you'd like to go, right?
I've been there.
Have you done that kind of trip?
I have.
That's very cool.
It is very cool. I like bears. I know you hate them.
No, I don't hate them. I'm respectful of them,
okay.
Which makes me very scared of them, which is different than hating
All
them.
right, okay, I'm rewiring myself.
You're kind of like drawn to them.
Well, little bears are very
cute. Which is not safe, Bramo.
Okay,
when you see the little ones...
I know, there usually is a large one right behind.
Very nervous about that and not gravitate
okay,
towards
you know, ADP is about to come out, so we can talk about that.
I'll take your direction. Equity futures right now in the S&P, positive by 0.4. That's the price action. Let's get you some morning calls. One stock in focus, SpaceX. First up, Hyperscaler cutting its price target, saying its AI cloud contracts are lucrative but could be cancelled. The second call from JP Morgan hiking its price target, expecting higher compute capacity and better monetization to boost AI revenue. And finally, Wells Fargo trimming its price target, saying it expects delays on hitting its ambitious targets. That name is down this morning by 11%. That's a single name for you. Let's get that economic data. The ADP number just crossed in moments ago. Mike McKee has more. Good morning, Mike.
Good morning, John. It's a miss to the extent that you could forecast ADP. It's 44,000 jobs created during the month of July in the private sector. That is less than the 65 that was forecast. Last month's 98 revised down slightly to 95. What's really kind of interesting is you look under the hood here at where the jobs were created and or lost. Natural resources and mining lost 6,000 jobs. Could that be a cutback in oil drilling? Don't know at this point. Construction only adding 1,000 and manufacturing adding 2,000. The service providing jobs, as always, interesting. Education and health services, the leader, 36,000 jobs. That one has ratcheted down in both this survey and the non-farm payrolls survey over the recent months. But leisure and hospitality loses 11,000 jobs. Now, that's very unusual during the summer. Normally, you would see gains, especially for June and July, as they ramp up summer camps and amusement parks and people go out to eat and sit outside. So that's kind of one to watch when we get to Friday and see what's going on. The pay numbers from ADP, job stayers 4.4%, job changers 7%. So I guess the story is go find a job somewhere else. The question is, do people think they can? And that's what we've seen in those consumer confidence numbers worsening.
The green light's get a new job, Mike McKee. Thank you, sir. Not sure what Mike's trying to suggest this morning, but
guess, we may be here tomorrow, we may not.
Take it and run with it. Andrea Hollenhorst, The City, writing this morning. We do not see risks that the labour market is retightening and becoming a source of upward pressure on wages and prices. Andrew joins us now for more. Andrew, good morning.
Good morning.
Certainly that ADP number would validate that view.
Yeah, a little bit weaker on the ADP. It's a pretty volatile number, but I would say in the context of labor market data, that's just in general been very volatile. So we had much stronger payrolls readings at the beginning of the year, had a weaker report in the month of June. We think we're in store for some weaker reports upcoming.
Goods, services, energy and labour, the sources of inflation. Labour's not really been a source of inflation over the last 12 months, not a major one. Anyway, the inflation is coming from other places. Where do you get confidence that that disinflationary path will continue, and where does it come from?
I'm a lot more confident now than I was even a few weeks ago after we had the June inflation report. You look at these various underlying measures of inflation, and there's always an issue when we say, which measure are you looking at, right? This is part of what came up in the press conference with Chair Warsh last week. But when you look at the various measures that we have of underlying inflation, most of them are telling us that inflation is slowing, and it's not that far off of target. I know that's very different than a lot of people's perceptions of what's going on, but if you look at the actual data, you can look at a trimmed mean, you can look at a median, you can look at core CPI. Core CPI inflation is not an esoteric measure of inflation. This is one of the typical measures that anybody would look at to try to assess what's going on with inflationary pressure. 2.6% core CPI year on year. That's not far off of what would historically normally be 2.3%. And we think we're going to see that 2.3% number in the next couple months.
Why do you think it's going to continue going down, right? And this goes to the question of sufficiently restrictive and the faith of the path of some of the inflation reads. Why isn't it just a one-off tied to energy prices and a couple of other just comparative reasons for the disinflation?
Yeah, what's happened with headline inflation, that is a function of energy prices. They came up, that boosted headline, they've come back down, that's going to drag on headline. If you look at the core measure, though, we got a very weak reading for core CPI and core PCE in the month of June. That extreme weakness might not repeat, but what we saw in those readings, if you looked at the underlying data, was broad-based lack of inflationary pressure. You see it across all categories of inflation, a significant slowing in the month of June, in particular shelter prices. And I think go out and look at house prices, look at rents. These enter official measures of inflation with a lag of about a year, maybe a year and a half, and they've been very slow. So those shelter prices should stay slow. That's a key reason that we're going to have slower inflation going forward.
How do you then understand the move that we've seen down at the front end in terms of yields, or essentially pinned, and the rise in long end of the yields? It seems like the market is saying something very different to what you're saying. How do you interpret that?
So if you look at the market, and this is another thing that, again, maybe very different than how some people are talking about this, the market is not worried about inflation in the U.S. If I look at the market that assesses that most carefully, which is the market for inflation-linked securities. So if you look at inflation break-evens, if you look at inflation swaps, we are pricing inflation to be around 2% for the next 2 years. We're pricing inflation to be around 2% for the next 10 years. So this idea that higher, longer-term yields have something to do with a lack of Fed credibility and an expectation that inflation is going to run persistently higher, it's just not the case when you look at markets. The movement that we've had higher in long-term yields is in real yields. It's not in the inflation component. It's in the real yield component. And why are they higher? It's what you've been talking about all morning, and apparently with your children at bedtime, which is the debt and the deficit in this country.
Are inflation expectations anchored because people still believe this Fed will hike? If they believed your story, I wonder where they'd be.
We have a probability of a hike that's priced in, right? The Fed came into July. There was a 30% probability that they were going to hike coming into July. At some point, there was a 50% probability that they were going to hike in July. The Fed declined to hike in July. We got a very small movement higher in inflation break-evens, but staying really at low levels. So what I saw there was an indication that the market doesn't need the Fed to hike one time or two times, which is essentially what's priced in, right? One or two hikes from the Fed. That's not going to be determinative for inflation. The trend in inflation is not going to be significantly affected by the Fed being 50 basis points higher or 50 basis points lower. If we have a big inflation problem in this country, if we're accelerating in inflation, you would need rates 100 basis points higher, 150 basis points higher.
Yeah, I don't think any of us are suggesting we have a big inflation problem with regards to where the index, the target, is right now. But it's a problem. It's been 5 years above target, and is that not evidence that they are not sufficiently restrictive?
You don't restore, two things on that. Number one, you don't restore credibility. And I agree, credibility has been damaged, right? This is a Fed that said inflation is transitory, and 5 years later, we still have above target inflation. So clearly there's been a hit to credibility. You don't reestablish that by hiking just for the point of hiking and showing that you can be tough in the face of even many underlying inflation measures that are slowing. You establish credibility by watching the data and effecting the appropriate policy to bring inflation down. Now, the question is, do we have the appropriate policy to bring inflation down? If you step back and don't just look at the last 6 months, look at the last year of data, look at the last 2 years of data, inflation has slowed, the unemployment rate has come up. If you look at the housing sector, we clearly have restrictive rates for the housing sector. So I do think that we still have rates that are modestly restrictive here. And I think a lot of Fed officials actually think that also. Their voices are not as loud right now. That has not been the market narrative. But hiking 25, 50 basis points, I don't think will do anything to restore Fed credibility.
Modest is different to sufficient. You'll acknowledge that. Modestly restrictive is different to being sufficiently restrictive to get inflation back to target. Do you think we're sufficiently restrictive?
Definitely sufficiently restrictive. Most measures of underlying inflation are basis points away from target, and in a couple months, it's going to look even better than that.
What's the argument for cutting rates? If you don't think that there's going to be much accomplished by hiking rates, what's going to be accomplished by cutting them?
Yeah, so on the inflation side, that would really be the argument for not raising rates. If we're slowing down towards target inflation, then that's a reason not to raise rates. Cutting rates, you have to have some concern about the labor market or about activity, and there are no concerns right now, right? So we're kind of looking at a Fed and a market that's treating this in kind of a single mandate context because we just don't have a concern on the labor market or on activity. We think we're going to see in the data, because of a residual seasonal pattern that we have in the labor market data, softer labor market data over the next several months. We obviously had a softer reading for the month of June. If the unemployment rate starts moving up again, then it will no longer just be a question of what's the right rate to set for inflation. Then you'll be concerned about the labor market.
What would it take in the data for you to just say that the Fed's going to be on hold with no more cuts?
Unemployment rate that just stays where it is.
Until
kind
when?
Of bounces around, 4.3, 4.4. Then they could be cutting eventually, but this is probably, sometime next year, maybe deep next year. Because then, back to John's point, for credibility, you might as well just stand pat and say, look, I want to be indicating that I'm super credible here. I'm fighting inflation. We have no issue in the labor market. So I'm just going to hold things modestly restrictive until I see that we're at 2% inflation, and we're not there yet.
What's your guess for Friday?
115,000 on the payroll, so I think it's a decent reading on the payrolls number. We had a much softer number in the month of June, which came through. The thing to watch for here is actually there are two things. One is, do we get a revision down to the June number, a further revision down? That's what we've seen in previous Julys. And the unemployment rate we have just ticking up to 4.3%. Last month, that participation rate fell by 0.3 of a percentage point. If that moves back up, unemployment can pop up much higher.
Interesting. Andrew, good to see you.
Thank you.
Andrew Honhorst of Citi. Looking for those cuts later this year, but still looking for 115 this Friday.
Yeah, how a good number can still be bad, or in other words, not necessarily erase some of the concerns under the hood.
If we get 115, I think we'll be talking about hikes, but they're still talking about cuts.
Yeah, because ultimately he sees that as not lasting. Although I always love talking to Andrew because I like to hear the contrarian view.
Interesting how it's contrarian, isn't it?
Isn't it?
And how quickly it's contrarian. Start of the year, it was not.
Yeah.
It is now. Up next, Nisha Patel of Parametric, bullish on Treasuries despite uncertainty over at the Federal Reserve. "60 minutes, 1 hour away from the opening bell following the biggest one-day gain on the S&P 500 since April. Equity futures this morning on the S&P 500 firmer by 0.5, on the Nasdaq up by 0.2. In the bond market, we'll talk lots about it in just a moment. Treasuries this morning, yields a little bit higher by a single basis point, 420 on twos, 10s unchanged at 461, 30s around 516, and a lot of discussion about supply, not just stateside, but worldwide. Mike McKee has more. Good morning, Mike.
Good morning, John. We're just getting the quarterly refunding data from the U.S. Treasury Department. $25 billion in 30-year notes, $58 billion in threes, and $42 billion in tens. It looks like they're basically unchanged from the past. Now, what everybody's been waiting for, and I'm just looking for the data, the information right here, is whether Treasury would drop their forward guidance. They have been guiding that they would not change the auction sizes for some quarters to come, and that is been as the deficit rises and as the need for borrowing rises. That's been a question on Wall Street as to whether they are going to do that in the future. And I'm looking at this point to see if we have any additions to that. The balance of Treasury financing, they say, still meeting them with regular weekly bill auctions, and they are leaving the size and composition of the SOMA portfolio the same. So based on projected borrowing needs, Treasury anticipates maintaining nominal coupon and floating rate auction sizes for at least the next several quarters. So they're keeping their forward guidance in place, even though Fed's getting rid of theirs. The question is, do they have to change that at some point soon because they're having to borrow a lot more? They raised their net borrowing requirements to $739 billion, up by $68 billion for the current quarter.
So, Mike, stay tuned, stay close. So just go through those numbers again for everybody. So quarterly refunding comes in at 125, in line with estimates. For the tenors and the dates, 3-year note auction at 58 billion, August 11th. 30-year bond auction, 25 billion, August 13th. That's one to watch for sure. 10-year note auction, 42 billion on August 12th. We've talked lots about this, Lisa. The Treasury Secretary, Scott Bessent, before coming into the job, critical of the previous Treasury Secretary for not terming out the debt, extending the average maturity of the Treasury. The issue is now that you're kind of boxed in. You've brought in the average maturity already. It's difficult to term it out, particularly given the pressure at the long end and the additional supply you're seeing from elsewhere.
And a lot of people are expecting the Treasury Department to ultimately depend more on T-bills to finance the U.S.'s needs rather than, say, coupon issuances, just simply because of exactly the dynamic that you're talking about. What could cause a change in that? At what point will the coupon market start to provide an opening? At what point will the bill market start to push back? And ultimately, these are all questions that haven't been tested because we haven't seen the increased sizes to the degree that really
Mike,
the market was expecting.
Just to jump in to build on Lisa's point, to what extent is the current Fed communication effort complicating the Treasury Secretary's ability to extend the average maturity coming out of the Treasury?
Well, it does create uncertainty at Treasury about what the rates, especially at the longer end, are going to be. And as Lisa points out, we've seen them rise in recent weeks. The question is, when does Kevin Warsh sit down with Scott Bessent and come up with this new Treasury Fed accord that they have talked about, which would try to coordinate Treasury issuance with Fed buying? The Fed wants to move towards a much more bill-heavy composition of its balance sheet. So the two of them have something to work out there. We don't. It may not be at the highest part of their agenda, but it is potentially a problem for the administration as they try to get a budget through for next year, because obviously the cost of interest is going up significantly.
Mike McKee, thank you. Appreciate it. Thank you very much. Nisha Patel of Parametric with a bullish outlook on fixed income, writing the following. High yields have improved the opportunity set. Bonds are no longer just a ballast tool. They can again be a meaningful source of income. Nisha joins us now for more. Nisha, good morning. Good to see you.
Good morning, John.
No big surprises for that quarterly refunding. Yields up at the front end by only a basis point. 10s up just a little bit, so not a big move in the bond market. Supply. Are you willing to step into the Treasury market facing down this increase in supply, not just from Treasury, but from everywhere?
Yeah, I think that's a good question. And this higher supply narrative has been affecting the corporate bond market, Treasury market. And we've seen that's been a reason why we've also seen yields higher. But I think there's a point where yields are compensating investors enough for them to start stepping in. And I think this is the point where you're starting to see that. So, of course, supply and demand mechanics are going to be very important. But I think this is the point where you start to see an increase in demand because yields, real yields, are starting to compensate investors. So I think from the Fed meeting last week, I know you've been talking about this a lot, we are going to see more volatility, so I'm not here to say we won't see that. But again, the income profile now looks so much better. And I think that is what's exciting for fixed income investors, right? The whole income component, your starting yields here are starting to look very attractive.
Which income component, I guess, is the key question? Is it the government income component, or is it the corporate spread, right? Which actually poses a greater opportunity in your mind?
Yeah, so look, in the IG corporate space, we've seen spread, yields kind of increase about 50, 60 basis points. And so I think, again, your stronger balance sheet companies with strong fundamentals, I think there's still an opportunity there. You're not buying it for spread compression, but again, you're buying it for yield. You're buying it for income. Your weaker balance sheet companies have less margin for error. So this is where I think you really want to be diligent about credit, and you want to be thoughtful about how you're taking on duration. Even in the Treasury, right? I'm not saying, and I know this is a question, and maybe I'm answering this too early, I'm not saying you go out and buy the 30-year.
Thank you.
But I think the 10-year is a good spot to, again, if you're sitting in cash, true cash products, right, and you have a risk there of, let's just say the Fed is on hold, there's still a significant amount of reinvestment risk, you're now getting paid to take on some duration. Another market, a lot of our client base at Parametric are high net worth individuals, higher tax rates, municipals. Believe it or not, right, rate volatility, supply dynamics there have shifted the profile of munis to where on a tax equivalent basis, you're looking at 5.5% to 6% tax equivalent yields in just the 10-year part of the curve. Think about that, right? High quality states, geos, issuers. So again, the credit profile has to be healthy, but I think you're getting compensated for that.
What makes you feel more confident that even though yields are elevated, they're not going to go up significantly more, given the borrowing needs that have not yet been announced, not just by the government, but also by hyperscalers?
Yeah. I think that's a good point. And I think it's very difficult to obviously call it and get it right. But I think what makes this more opportunistic at this point is that your income profile is helping hedge against potential upside in yields, if that makes sense, right? So a lot of our clients, you're burned by what happened post-pandemic. When you were buying bonds at 1.5%, 2% yields, you don't have a lot of cushion when yields move up even 25, 50 basis points. At this profile, right, 4 or 5% yields, you can have rates move up and still be able to absorb it and still be in the green. Now, I would say the hedge on the other side. Now, I think my view is the Fed stays on hold. I'm not, kind of in this camp that we get a cut. I know Andrew made a very compelling argument earlier. But the hedge here is if you do see softer labor market data, if the Fed does stay on hold. Now, softer labor markets, right, I think the consumer is a big part of this. So what I'm watching on the consumer side, softer labor markets, does that lead to ultimate a softer consumer? The ADP number that we just saw in services in certain markets, are you seeing less leisure travel, right? Are you seeing some of that being pulled back? If we start to see that in the second half, you can make a strong argument that if inflation does naturally come down, does the Fed then have a better platform to start cutting next year? And you just see a trend of yields coming down, in which case I think bonds provide a good hedge. So again, I think bonds today at the income profile that we're seeing, it's attractive in all the, I guess, both outcomes that we could have.
Do you see any of that slowdown on the horizon currently?
Labor market?
Yeah, in the consumer, in the labor market.
It seems like, look, with the economy, earnings has been incredibly strong. We have seen generally I think, good labor market. I wouldn't say it's exceptionally strong. I'm not sure the slowdown is occurring just yet, right? But energy prices has been a big component of this. We have seen energy prices come down. I still think you're seeing a relatively healthy consumer. But again, this all permeates into a few different things. If you do see a slowdown in the labor markets, you do start to see an uptick in layoffs. You don't have wage growth happening at a time where inflation is still fairly stubborn in some areas. Real income and discretionary spending for consumers can be very difficult to keep up or to stay positive. So I'm not sure we see that in the next quarter, but it's quite possible we start to see some of this in the last half and beginning of next year.
How about that 30-year? How did you know we're going to ask? Is that predictable? Nisha, thank you.
Thank you so much.
Appreciate
Just like Lisa's trying to explain to her kids about debts and deficits, I'm just getting my kids to understand bonds. So
I'm sure you're doing a great job.
That's the start. They're a little older.
That's step one.
Step one.
Step two is you bring Alicia around. Nisha Patel, Parametric. Nisha, thank you. Appreciate it. With an update on news worldwide this morning. With your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. The U.S. quarterly Treasury funding coming in at $125 billion, in line with estimates. The Treasury will issue the refunds via $58 billion of 3-year notes, $42 billion of 10-year notes, and $25 billion of 30-year bonds. The agency projects steady nominal auction sizes for August through October. ADP payrolls coming in weaker than expected for July. Private sector employment increasing by 44,000 versus estimates for 65,000. Service providing jobs falling by 3,000 for the month. Uber shares are lower by about 3% in the pre-market. The company's gross bookings falling short of the high end of Wall Street expectations. Uber citing currency headwinds and fierce competition in international markets for weighing on trip volume. Tune in to Bloomberg Tech at 11 a.m. Eastern for an interview with Uber CEO Dara Khosrowshahi. And that is your Bloomberg Brief. John.
Vonnie, thank you. Thanks for this morning. Up next, we'll set you up for the day and the week ahead. Plus, we'll catch up with Noah Weisberger of BCA Research with stocks back at all-time highs heading into the market open.
I don't think there's too much capital coming to the market. I don't think the IPOs are too big. I think there's a massive wall of capital coming to this, not just in the U.S., but globally, because where else are you going to go with that wall of money? Other markets are simply not big enough.
Alicia Levine of BNY Wow still bullish and constructive on this equity market for good reason, given the run we've just seen. 4 days of gains, almost 6 percentage points higher. This morning, futures positive too on the S&P 500, up by 0.5, up a quarter on the Nasdaq. Into the bond market, let's just sit on this just for a moment. 2s, 10s and 30s. More supply is coming in line with expectations. You will get a 3-year note auction in the next week or so, $58 billion worth. 10-year note auction, $42 billion. 30-year bond auction, $25. 30 years going to get tons of attention at 516.59 as things stand. The guidance from the Treasury, they'll maintain auction sizes for at least several quarters. And we've been wondering whether they'd be increasing, Bramo, and getting bigger and bigger, because we were looking for them to term out that debt at the start of this administration, and it ain't happening anytime soon.
Right now, the idea of terming out debt at more than 5% yields does not seem particularly attractive to at least this Treasury Secretary right now. Question is, how will the market receive all of the T-bill issuance, and how will the Fed receive it, given the fact, as Mike was mentioning, there is a speculation about a Fed Treasury Accord to coordinate some of the purchases of the Fed's balance sheet, which are front-loaded to the T-bill side with the Treasury Department's issuance.
So we're just going to make it super short-term debt, and then the Fed's going to buy super short-dated debt as well. Is that how this is going to work?
I mean, it potentially could, and potentially it could work in the short term, but then it also creates greater political risk for the Federal Reserve because they'll be setting rate that much more directly for the U.S. government. So it becomes that much more of a complicated tool to use to potentially combat inflation.
Makes it even harder to hike.
Correct.
Right? And then if you're looking at the Treasury and the Fed working like that together, look, we're not there yet. I'm just sort of thinking out loud about this. It's a massive sell on the US dollar, surely.
Which is the reason why a lot of people are saying there is that extra premium, and you're seeing it in the real yield, not necessarily in inflation expectations, following the Fed's meeting and some of the speculation around this that has come in tandem with the dollar weakening.
That's the bond market fear right now at the longer end of the curve. 30-year yield still slightly untethered.
You just need to have a little bit more compensation to offset that risk.
Some counselling at dinner time. Our next guest walked into the studio and said, is this a family... What was it? A parenting show now. A parenting program.
All right, I'll stop talking about it. It's just, okay. It's 3 hours.
I want you to talk about it. Don't
all right.
About it.
Well,
everybody wants you to talk about it.
My kids definitely do not.
What we do.
Thanks.
As we count you down to the cash open, some 43 minutes away. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. One suggestion, don't let your kids buy at the IPO, as we're seeing with SpaceX. This is the most actively traded stock in the pre-market. Shares are falling 11.5% after it gave Wall Street a bigger CapEx number than it was expecting. The quarter itself beat estimates, but you can feel the angst as investors digest the enormous amount of capital it will take to transform this company from a rocket company to an infrastructure one. Plus, I will note that its IPO lockup expires today, allowing insiders to sell shares for the first time. So that is also weighing on shares. Let's get to the earnings we've gotten this morning. We start with Uber down 2.75% after it gave a bookings outlook that just met expectations. And in this market, that is not enough. Investors seem to also be zeroing in on its trips growth. That had a slight miss, and that is due to tougher competition by Chinese rivals in Brazil, which is Uber's largest market by trip volume. So that really caused a dent there. And we end on Disney shares. Those are moving to the upside, up 3% after its biggest businesses, entertainment and experiences, delivered. Streaming keeps getting more profitable, and in a testament to consumer strength, its park business saw strong attendance and strong growth. So all that contributing to a healthy EPS beat by Disney. John?
The park business just absolutely crushed it. Yahara, thank you. Appreciate it. I love Brammo. It's a 3-hour show. Of course, I'm going to talk about what I had for dinner last night. Right? Obviously. I've got so much time to film
Well,
this.
yeah. I mean, look, things come up, you know? I mean, it's...
Just working through the show plan 7C, which I'll mention what we talked about over dinner last night. There you go. Let's talk about stocks. Looking to add to record highs. Iron gave fifth straight day of gains. Noah Weisberger of BCA Research looking for an 8,100 year-end target on the S&P. He writes, consistent with our outlook for the second half of the year. Risks stem mostly from the bond market and a wave of IPO activity, both within the potential to impact valuations more so than earnings growth itself. Noah has more. Noah, good morning. It's good to see you.
Good morning. Thank you for having
Any
me.
parenting advice have you got for anybody?
Talk about bonds at dinner. I mean, that works like a charm.
Do you like that?
It's how we've raised ours.
What's the reaction?
Four liberal arts majors. That's the reaction.
That's what's happening.
Yeah, artists.
Okay. Do you want to start with this bond market?
Absolutely. I mean, I would just piggyback on kind of some of the comments that you were making. This is the biggest risk. We're watching the break-evens also, and that's been a little bit scary to me. What's driving the bond market isn't all risk, to be fair, right? We have a bit of a pickup in the cycle, which should help, which supports yields, which is in a good way for stocks. But the other two factors less positive for stocks. One is this risk premium that comes from, when you talk about a Fed Treasury accord, that really makes me nervous. I think that's behind the shift in correlation that we've seen in the last couple of years, the risk of that Fed independence going away or waning a little bit. And then the last thing I'll say, which isn't a Fed issue, it's just kind of the broader context, which is capital is scarce. We have this huge amount of demand and against constrained supplies. And that's both from the federal side and also what we're seeing in the private markets in terms of the CapEx spend. So
let's unpack some of that. So what is scary about break-evens?
I think losing the inflation anchor, I think, is a direct impact to a long-duration asset like stocks. And so I think that's, we've said the earnings side is great. The valuation side looks better because of a bit of a sell-off against the backdrop of strong earnings growth. But that all changes if you inject risk premium into the bond market or if you inject inflation risk premium. And then you have to sort of change your valuation calculus.
You are an equity bull, and I've got to jump in. You've got an 8,100 target on the S&P. This is what's strange about this moment for us at the moment. And you would prefer the Fed to hike?
It feels strange. And I actually thought until the press conference that Warsh had done the exact right thing, which is to tell everybody how much he wants to see a 2% target and hold off on hikes and convince everybody that he's well in control, he's got everything balanced perfectly, and he'll do the right thing at the right time. If I were on the FOMC, I'm not sure I would be hiking just yet. I think I'd wait a little bit to see headline inflation wash through. And to be honest, it feels a little bit like a tempest in a teapot, meaning I don't think that Warsh has completely capitulated on all that hawkish credibility, and we may be a little bit overreacting to how poor his communication will be and how much we don't know. It feels a little bit like a hair on fire moment, but I prefer that the bond market hadn't reacted the way it did.
That said, we just had an all-time high on the S&P 500. Where exactly is it hurting stocks?
Well, I mean, imagine where we'd be at a lower yield and lower inflation. It's not. It's not because the earnings picture is so strong. And I think I was here a couple weeks ago, and at one point you asked me earnings, and that's still the case. What worries me on the earnings side, one, there is some fluff in those numbers. Like, was earnings growth 40% in Q2? Well, not if you take out the impact of IPO valuations. That's another risk to this market. We have a lot of supply coming, but that still gives you a pretty good cushion. The other thing that worries me is there's not a lot new to my own bullish story, right? We saw Q1 was amazing. Q2, it's kind of a rinse and repeat, which is great, but at some point that should be in the expectation set. So those are the other things that make me a little bit more balanced. And we've tried to lean in that direction, focusing on the bond market risk, focusing on what's new. We've tried to take a little bit more of a quality approach. So a little bit moving away from small caps. We've added gold to our set of recommendations as a uncorrelated, gold miners, I should say, as an uncorrelated piece of the portfolio. So that's a shift in our body language, but still constructive.
Nothing about any of this says bull. I mean, this is what's so funny to me is that, like, this is, you don't...
Talk to my kids. No.
I'm just curious, like, nothing sounds bullish that you're talking about. You're talking about concerns that you've already seen everything that you need to see. Nothing's new. You're not getting surprised. There's a potential overhang of duration. There's a potential of weakening under the hood that's not getting priced in.
You know, 8,100 sounds like a massive number, but I think it's only 5% away now.
Yeah.
Yeah, but still, it's a gain, and although
Four more days, that's all it'll be. No,
it's true. Actually, you're not wrong.
Look, what's good about this market is that the CapEx spend is real. We also seen a broadening out, right? So it's not just the hyperscalers. Like median EPS growth is quite strong. We've seen financials start to participate. Some of that is off of trading revenues. It's not kind of the long-term good stuff that you want to see, but that hasn't been so bad either. Energy's boosted earnings for the market overall. And you still have this CapEx theme, and you have, you know, I would look, again, I think you want to be careful with leverage here. So I like software. You've got existential risk further out, but I think right now you're hearing good commentary about them able to monetize their AI exposures.
Can you like chips and software?
Probably not. And I think chips have had a great run, and I would lean away from them. And I like the hyperscalers. I think hyperscalers may face some political risks down the road when they have these great, but what you like about them is these great vertical integration, where I don't need to pick my spot exactly. I think that becomes a political risk. You've got me talking about risks all the time. You know, that's a political risk down the road.
Sure, blame me. But I'm just saying, these are the concerns.
Yeah, and again, but they're able to, and they're turning those investments into earnings. And that's the most important thing to keep tabs of going forward.
No, I always love catching up with you. It's good to see you again.
Great, thanks for having me.
Thanks for being here. Noel Weisberger there of BCA Research. We were talking about vacations with him in the commercial break. I'm not going to give anything away. But just listening to a strategist talk about how strategic they are about where they stay, what date they go, and how long they stay there for. Extracting value everywhere they look.
Yeah, looking for times when potentially there's a mismatch in some of the calendars versus the vacation period. Well, I mean, you think about it, how many people have gone to a place like Japan because of the yen?
Oh, without a doubt.
I mean, because it's
From the
it's a
States?
100%.
Sure. Once
I mean,
in a lifetime.
You look at it, you do your balance sheet, you get a sense of exactly where you're going to go, how you're going to do, how much sushi you're going to eat, and it's exciting.
I was going to do that once. TK and I pitched a program.
I remember this.
Do you remember? Years ago, the dollar was like sky high, and we were just going to select like 5 different countries and go on tour with the US dollar at sky high levels.
What was the response from some of the
They didn't buy into it. It was previous leadership have since gone on to do other great things
so maybe you
in the media industry.
Maybe you should go try to pitch it again.
It didn't work. It was like the currency tour.
I think that's fantastic.
We were going to Argentina. We were going to some beaten up places in Southeast Asia.
If you want that show, write in.
We were going to have like a dinner, a meal with economists and stuff. It was going to be great.
With economists.
Sponsored by an airline.
Over there, yeah, exactly.
This was all going to work.
We can reprise it.